Good evening, friends. So last class we completed all the cost variance calculation. Settle down. And we started doing a problem where we have to calculate all the cost variance and prepare a reconciliation statement comparing the standard cost and actual cost. In that problem, I think we completed material and then labor variances. Please stop talking. Let us continue and complete the problem. After calculating variable and fixed overhead variances, we will try to compare the cost and do the reconciliation. Once we complete that particular sum, next I will discuss an area called as marginal costing versus absorption costing. Why I need to discuss is then only we can understand sales variance and then main reconciliation problems. Without that understanding, it is difficult to proceed further with the standard costing chapter. So we just deviate little bit from this chapter. I am not going out of the chapter. I am only discussing a relevant issue that will make us comfortable in understanding the remaining portions of the chapter. We discuss the area called as marginal costing versus absorption costing. How to reconcile a marginal costing profit and absorption costing profit, that will be discussing elaborately in today's class. That is the second issue. Once the discussion is over, we will discuss sales variances. Very easy to calculate, but lot of issues to discuss. That we will be discussing the sales variance. We will probably try to complete the sales variance in today's class. Next class onwards, we will start doing the big problems, that is reconciliation types, where so many issues will be learnt. Let us first summarize what is done in this chapter before we continue and complete this problem. So I want full silence, please. Standard costing system reconciles the budgeted profit and actual profit. The reason for the difference are called as variances. So it is also called as variance analysis. Profit may vary due to revenue side or cost side. So variances are classified as sales and then cost variance. Cost variance are further analyzed into material, labor, variable and fixed overhead variances. If a variance is increasing the profit, it is called as favorable. If an item decreases the profit, it is called as adverse variance. First, we started discussing the cost variance. There are three types of cost: budgeted cost, standard cost, actual cost. Budgeted cost is budgeted cost for budgeted output. Standard cost is also budgeted cost but for actual output. Actual cost is cost actually incurred. Cost variance does not compare budgeted cost and actual cost. In fact, it compares the standard cost and actual cost. In simple English, budgeted cost is cost planned. Standard cost is cost allowed for the output that has been achieved. Actual cost is cost actually spent. We started discussing the variances. Material cost variance. Single raw material, mix of raw materials. We have how many steps? 2 steps. Computation table, variance calculation. Single raw material, tell me the computation table. How many columns? 3 columns. SQ into SP, AQ into AP, AQ into SP. The material cost variance is 1 minus 2. Price variance 3 minus 2. Usage 1 minus 3. Where SQ means standard quantity for actual output or the material quantity allowed. And what is AQ? Actual quantity. SP standard price. AP is actual price. Next we discuss about the mix of raw materials. We will be having fourth column. What is fourth column? RAQ into SP. RAQ is actual quantity in standard mix. You can even call it as RSQ. The variance usage is further analyzed into mixed variance and yield variance. Mixed variance 4 minus 3, yield variance 1 minus 2. Labor variance is also single labor, mix of labor. Single labor, how many columns in computation table? 3 columns. SH into SR, AH into AF, AH into SR. Where SH means standard hours for actual output and AH means actual hours. SR standard wage rate, AR is actual wage rate. Labor cost variance 1 minus 2. Branches into rate variance, efficiency variance. Rate is 3 minus 2. Efficiency, when you have mix of labor, the fourth column is RAH into SR. Actual hours in standard mix. So the labor efficiency branches into labor gang variance, labor productivity variance. Gang is 4 minus 3, productivity is 1 minus 4. When you have idle time, then the labor efficiency should be further analyzed into idle time variance and revised efficiency variance. Idle time variance is idle time into standard rate. It is always adverse. And revised efficiency variance is also 1 minus 3. But column 3 AH into SR is AH worked into standard rate. Then we discuss about variable overhead variances. How many steps are there? 3 steps. First step is standard rates. Second step is computation table. Third step is variance calculation. Standard rate per unit, SR per unit is equal to BVO by BO. SR per hour is equal to BVO by BH. Then the computation table, how many columns? 3 columns. Column 1 is SH into SRR, AO into SR, AVO, AH into SRR, SO into SR. SO means standard output for actual hours. SH means standard hours for actual output. The variable overhead cost variance 1 minus 2 branches into expenditure variance, efficiency variance. Expenditure variance is 3 minus 2. Efficiency is 1 minus 3. Then we discuss about the fixed overhead variance. Again same 3 steps. Step number 1 is calculation of standard rate. SR per unit is equal to BFO by BO. SR per hour is equal to BFO by BH. Step number 2 is variance calculation, computation table. How many columns? 5 columns. Name the 5 columns. The SR are AO into SR, AFO, BFO, which is BO into SRR, BH into SR, AH into SRR, SO into SR, PFO. PFO is BFO into AD by BD. The fixed overhead cost variance 1 minus 2 branches into fixed overhead expenditure and then volume variance. Expenditure is 3 minus 2, volume 1 minus 3. Volume further branches into capacity, calendar, efficiency. Capacity 4 minus 5, calendar 5 minus 3, efficiency 1 minus 4. And fixed overhead variance is nothing but under absorption or over absorption. Column 1 AO into SR represents absorbed overheads. Column 2 AFO is actual overheads. Column 3 BFO is budgeted overheads. Absorbed is overheads accounted. Actual is overheads spent. And budget is overheads planned. Absorbed minus actual we call as under absorption or over absorption. Why under or over absorption arises? Because I charge the product using a standard rate and not using the actual rate. Why should I charge using a standard rate? Because actual rate known only at the end of the period. I cannot wait till then for doing my stock valuation. Why standard rate, actual rate are different? Due to numerator or due to denominator. Numerator difference we call as expenditure variance. Denominator difference we call as volume variance. Volume can vary due to 3 reasons. The number of days worked may change, increasing or decreasing the output, and the capacity of the given day also may change, increasing or decreasing the output, and the speed of working also may change. So calendar capacity and then efficiency influences the volume. All these issues we discussed. When you don't have number of days given in the question, in that case fixed overhead variance computation table will be having how many columns? 4 columns. What will be missing? PFO. And what happens to capacity variance? 4 minus 3. It will not be 4 minus 5. What variance vanishes? Calendar variance vanishes. Are all the issues we discussed in this chapter till now, right or not? Now, I had given you that notes at the end of the workbook regarding the fixed overhead variance discussion. Have you all gone through that? Oh. Can I proceed? No. I don't want to further investigate. Can I proceed or not? No. Next. Then I'll get upset. Then 1 or 2 minutes will be wasted for what? Advice. Okay, advice money, criminal waste of time, nothing in the world. Right? Now. Okay, now we have been doing that particular sum. Let us go into the numbers to get familiar, because we have forgotten in one day what has happened. So I'll make you familiar and then continue with the problem. Okay, I think we completed metal variance and labor variance. Just to have information, which sum we are doing? Another name, which sum we are doing? 10 sum. Okay, now please see. This is the basic data we obtain. Shall I proceed? See. The question gave you the following data first. Company produced 25,000 units. If you read the question, the company produced 25,000 units. How many labor hours were utilized? They utilized so many labor hours in which they could have produced how many units? 28,000. Please come into the problem, get into the wavelength of the question. Can we start or not? Now, company produced actually 25,000 units, which I call as actual output 25,000 units. I don't know. Now, but they worked how many hours? The answer is they worked so many hours. They worked how many hours? So many hours. In which they could have produced how many units? 28,000. So the 28,000 we call as what? Standard output. This is the output that should have been produced for the actual hours. So this is actual output in actual hours. This is what? Standard output in actual hours. In both the hours used is what? Actual. The output that has been produced, the output that should have been produced is a difference. Point number 1. Respond yes or no? Then with that we find out the standard hours and then what? Actual hours. Very simple. We had standard hours. What is standard hours? Standard hours for actual output. The budget says 1 unit. How many hours allowed? Half an hour. How many units I produce? 25,000. How many hours allowed? 12,500. Standard hours is nothing but time allowed. What is time allowed? 12,500 is a standard hours we found out. Respond yes or no? And actual hours. Actual hours is 1 unit, half an hour. How many units standard output? 28,000. This standard output for what hours? Actual hours. So how many actual hours here? 14,000 hours I found out. Very simple. I worked how many hours? 14,000 hours. And produced how many hours output? 12,500 output. I worked how many hours? 14,000 hours. In which I should have produced 28,000. I produced only 25,000. He is efficient or inefficient? Inefficient. Easily understandable. Yes or no? Apart from that, we also found out the budgeted output. They say the budgeted capacity is how many hours? 15,000 hours. So the budgeted output is how many units here? 30,000 units. All these numbers we wanted to have for calculating the variances. Respond. Is the first step we did. Yes or no? Then we started calculating the variances one by one. First we calculated what variance? Material variance. Please involve yourself. No need to copy. Already copy. Just for flow we are doing. Tell me the problem is having single raw material or mix of raw material? Single raw material. Everybody involve yourself. How many columns are there? 3 columns. Name the 3 columns. SQ into SP, AQ into AP, AQ into SP. SQ means what? Standard quantity for actual output. The standard says 1 unit of output. How many kg allowed? 3 kgs. How many units I produce? 25,000. How many kgs allowed? 75,000. 75,000 kgs allowed at how much price? 4.4. Actually, how many kgs I purchase? 80,000 at 4.2. And third is AQ into SP is 80,000 into 4.4. Other words, I am allowed to spend how much rupees? 3,30,000. I spend how much rupees? 3,36,000. Overspent, underspent, overspent. How much is overspent? 6,000 adverse is the cost variance. Why the cost varies? Maybe due to price. I plan to pay 4.4. I paid only 4.2. Saved, excess paid, saved. How much price per kg? 20 paise. For how many kgs? 80,000. The price variance is 16,000 favorable. Yes or no? Usage. For my 25,000 units produced, I am allowed to use how many kgs? 75. I have used how many kgs? 80,000. Underuse or overuse? Overuse. How many kgs? 5,000. And how much rupees? 4.4. Usage is 22,000 adverse. Innapa right or not? No. The material variance was calculated. Next variance is what? Labor. Tell me once again, 3 columns. What are 3 columns? Sir, AH into AR, AH into SR. SR means standard hours for actual output. We already computed or not? Tell me what is standard hours? 12,500 hours. Time allowed 12,500 hours. At what rate? 5 rupees. Actually, how many hours has worked? 14,000 hours. Paid at 5.4. 14,000 hours at 5. If I multiply, I will be getting this. Tell me, I am allowed to pay how much as wages? 62,500. I paid how much rupees? 75,600. So is that the adverse variance or not? Yes. How much a labor adverse variance here? 10,100. 13,100 adverse. Now, why the labor cost has varied here? Maybe due to the rate payment or due to the hours work. I plan to pay how much per hour? 5 rupees. I paid how much per hour? 5.4. Extra payment or less payment? Extra payment. How much paise? 40 paise. For how many hours? 14,000. Adverse variance? 5,600 rate. Yes or no? Efficiency. For my 25,000 units, I am allowed to spend how much time? 12,500. I have spent how much time? 14,000. Overspend how much? 1,500 hours. In how much rupees? 5 rupees. 7,500 adverse is a labor efficiency variance. Up to this, are you following or not? No. Yes, sir. Yes, sir. Next, let us continue. Now, part 2 or part 3, what is the part 3? Right on? Part 3. Part 3, variable overhead variances. We are going to do it together. Variable overhead variances. Okay, how many steps? Write down. Step 1, standard rates. Step 1, standard rates. Okay. Standard rate per hour. Step 1, standard rates. They write SR per hour. Please look at the first table. They said first table has given only wage and wage, that is the materials. Look at the second table. They get about the overheads or not. Tell me, SR per hour is equal to what divided by what? BVO divided by BH. Budgeted variable overheads divided by what? Budgeted hours. Ennappa, right or not? No. See, if you look at the question, I have been given 3 budgets. A budget for 12,500 hours, a budget for 14,000 hours, a budget for what? 15,000 hours. Ennappa, right or not? No. Which budget should I take? For variable overheads, any budget you take, per hour will be what? Same only because it's always constant. Ennappa, right or not? No. But I'll say, we should always go for what budget? Original budget. Originally, I prepared the budget for how many hours? 15,000. Later, I flex the budget for 14,000 or what? 12,500. That's a different issue. My base budget is for how many hours? 15,000. Because they said I normally prepare budget at normal capacity. Yes or no? For the normal capacity, 15,000 hours. So my budget really is for how many hours? Yeah, 15,000 hours. Can you use this particular data or not? Tell me. What is BVO? Budgeted variable overheads. 1,80,000. What are the budgeted hours? 15,000. Can you put the number or not? Now, write down. BVO divided by BH. Budgeted variable overheads divided by budgeted hours. Understand and write. What is budgeted variable overheads? 1,80,000. Divided by what are the budgeted hours? 15,000. 1,80,000 divided by 15,000. Tell me what is the number here? 12 per hour. 12 per hour. The budget says that every hour you run the factory, you are allowed to spend how much variable overheads? 12 rupees. Next is SR per unit. It's very simple. SR per unit. 1 unit, how many hours allowed? How many hours allowed? Half an hour. 1 unit, half an hour. 1 hour, how much rupees? 12 rupees. That's half an hour into 12 rupees. Half an hour into 12 rupees. What is standard rate per unit? 6 per unit. Standard rate per unit is 6 per unit. Answer my question. The budget says to produce every unit, what variable overheads allowed? To produce every unit, what variable overheads allowed? 6 rupees. When you work every hour, what variable overheads allowed here? 12 rupees. Now, out of the two, which is the primary cost driver? Hour. Secondary is what? Unit. Mainly, the variable overheads moves with what? Hour. 1 hour I work, I should spend how much rupees? 12 rupees. Just because I allot a half an hour time for a unit, I fix the standard as what? 6 per unit. Ennappa, right or not? So, units drives hours. Hours drives what? Variable overheads. The primary cost driver is hours, and the secondary cost driver is what? Units. Already discussed in the previous day's class, right or not? Now, next is what is step 2? Computation table. Step 2, computation table. Okay, what is the first column? SH into SR or AO into SR. SH into SR or AO into SR. Second column, AVO. Third column, AH into SR or SO into SR. SH into SR, AO into SR, AVO, AH into SR or SO into SR. In our question, all numbers are available in the first table itself, yes or no, but still we can use whatever you want, our choice. Can I proceed? Okay. For the benefit, I'll put the table once again, what has been done. Tell me, what is SH? What is SH? 12,500. Look at my pen. What is SH? 12,500. Yes or no? What is AH? 14,000. What is SO? 28,000. At least look at the pen and tell me what is AO? 25,000. Following. All we already calculated. Yeah, okay. So the standard was 12,500, actual was 14,000, SO is 28,000, AO is what? 25,000. Both choices one can use because all numbers are ready-made available in this sum. Can I put or not? Can I start putting the numbers or not? Any number you want, you can use for doing the calculation. Can I proceed? Now, SH into SRR, AO into SR. AO is how many units? 25,000 units. What is the SR per unit? 6. 25,000 units into 6. AVO. What is AVO? What are the actual variable overheads? Look at the problem. They are given in the last line. They say, however, variable overheads incurred amounted to how much rupees? 1,60,000. AVO 1,60,000. They are given AH as well as what? SO. SO is how many units? 28,000 units. Into SR is 6 per unit. SO is 28,000 units. Into SR is 6 per unit. Can I proceed? No. First is 1,50,000. First column is 1,50,000. Second column is 1,60,000. Third column is 1,68,000. 1,50,000, 1,60,000, 1,68,000. Can I proceed to the next stage? Now, step 2 or step 3? Step 3, variance calculation. Now, I have a doubt. Are you understanding? Yes, those understood, raise your hand. Because I don't see the same vibrancy what I saw in the last class. I'm afraid you have forgotten what has been done. Okay. The main problem is I cannot teach you the variance again and again. One start has been already covered. Already I taught you in IPCC. I am teaching once again in what? Final. I cannot repeat it again and again. The speed you should manage. Everybody following up? Now, write down next step. Calculation of variances. Step 3, calculation of variances. Don't talk, please. Calculation of variances. Center right, variable overhead, cost variance. Center right, variable overhead, cost variance, 1 minus 2. What is 1 minus 2? 10,000 adverse. Variable overhead cost variance, 1 minus 2, 10,000 adverse. Branch it into 2. Variable overhead expenditure variance, VO expenditure variance, and VO efficiency variance. Variable overhead expenditure variance, variable overhead efficiency variance. Variable overhead expenditure variance formula is 3 minus 2. Expenditure variance formula is 3 minus 2. Efficiency variance formula is 1 minus 3. What is 3 minus 2? 8,000 favorable. 3 minus 2 is 8,000 favorable. 1 minus 3 is 18,000 adverse. 1 minus 3 is 18,000 adverse. Variable overhead variances have been computed. Respond yes or no? No. Next is what? Fixed overhead variance. Last variance, part 4, fixed overhead variance. Fixed overhead variance. Number, can I proceed now? First, step 1. What is step 1? Calculation of standard rates. Step 1, calculation of standard rates. We'll do it together. Calculation of standard rates. SR per hour is equal to, I want you to answer me, SR per hour is equal to what by what? BFO by BH. SR per hour is equal to BFO divided by BH. What is budgeted fixed overheads? Tell me what is the number? 2,70,000. It will not change with every budget. In a fixed was always going to be having a static only. Okay, 2,70,000 divided by 12,500. 14, 15,000. Always a unitized fixed cost using normal capacity. Understand that. I elaborate that about that in the next stage of discussion. Marginal costing versus what? Absorption costing. Whenever I find out unit fixed cost, I find out unit fixed cost using actual overheads, budgeted overheads, budgeted overheads. The denominator budgeted output is what capacity? Actual, normal, full capacity, normal capacity. I don't budget the full capacity. I don't know the actual capacity to budget. I always budget using what? Normal. Budget means expectation. The word budget means what? Expectation. You expect abnormally or normally? When I expect 10,000 students to come to this room, I don't expect, will I expect one student? We always expect what? Normally what happens, one will what? Expect. So whatever is use the word budget always indicates what capacity? Normal capacity. No abnormalities will be there in the budget. Are you following what I am saying? In that case, I will divide it by 12,500 hours or 14,000 hours or 15,000 hours, 15,000. Why the question says 15,000 hours per month as what? Normal capacity. Ennappa, right or not? So tell me, SR per hour is equal to 2,70,000 divided by 15,000. 2,70,000 divided by 15,000 is equal to how much? 18 rupees per hour. SR per hour is equal to 18 rupees per hour. Next, SR per unit is equal to 1 unit. How many hours? Half an hour. 1 unit half an hour into 1 hour 18 rupees. Half an hour into 18 rupees. SR per unit is half an hour into 18 rupees. Is it how much rupees here? 9 rupees. Standard rate per unit is 9 rupees. Okay. Step 1 over. Step 2 is what? Computation table. Step 2 is computation table. I want an answer. 5 columns or 4 columns? All of you. Good evening, friends. Solliya. Respond. 5 columns or 4 columns? Why not 5 columns? Days are not given. Can I say? Now, write down first column. SH into SR or AO into SR. SH into SR or AO into SR. Second column AFO. Third column BFO. Fourth column AH into SR or SO into SR. AFO, BFO, AH into SR or SO into SR. Now, SH available, AO available, both available, both available. Anything which you want, you can just what? Use it. I use 25,000 units. What is 25,000 units? Actual output. Into 18 or 9? 9. Because units should multiply by per unit. Okay, 25,000 into 9. Now, listen here. If you read the last sentence, they said, actual fixed overheads. Look at the problem, last paragraph. Actual fixed overheads did not deviate from the budgeted amount. What I budgeted only, I actually spent. Right or not? That means BFO is equal to what? AFO. There is no what variance? Expenditure variance. There is going to be no expenditure variance. Yes, now, see, there are 3 columns now. What is column 1? You don't read from the slide. Yes and yes. What is column 1? Absorbed overheads. Column 2 is what? Actual overheads. And column 3 is what? Budgeted overheads. Overheads accounted. Overheads incurred. Overheads planned. Now, absorbed minus actual is called as what? Under absorption or over absorption. My question is, if budgeted and actual are same, should absorbed also be same? Because the numerator only is same. When the volume changes, the absorption changes. So no? Yes, very simple. Yeah? I plan to spend 4 lakh rupees rent. I also spent what? 4 lakh rupees rent. In that case, rent plan and rent spent is what? Same. But with the 4 lakh rupees rent, I plan to have 400 students. But the same 4 lakh rupees rent, I had now how many students? 800 students. Even though the expenditure did not change, the volume has changed. Yes or no? Due to which the over absorption will take place or not. So don't think that when budget and actual are same, absorbed also should be what? Same. Absorbed not only depends on expenditure, it also depends on what? Volume also. Everybody follow what I am saying? And one more thing. Suppose a question did not give you the last sentence. Actual fixed overheads did not deviate from budgeted. This sentence is not given in the question. Then what you will do? I'll assume it to be same. Because it is not abnormal. Fixed overheads generally will be estimated correctly. Yes, can't the company estimate this room rent correctly for a year? Can't a company estimate the salary cost of a year correctly or not? Because fixed overheads are generally committed costs only, whose estimation will not prove to be so much different than actual. It is not volume dependent, it is only negotiation dependent. Yes or no? In that case, mostly if they don't give anything, we can safely assume that budgeted overheads is same as what? Actual overheads. There is going to be no expenditure variance. Are you following or not? There is no necessity for the question to say that actual did not deviate from what? Budget. Even if they don't say it also, the budget and actual will be assumed to be what? Same, unless I give you some information to the contrary. Are you following? No. So in that case, let us continue. AO into SR. What is AO? 25,000 units. What is SR? 9 rupees. Participate. What is AFO? What is AFO? 2,70,000. Tell and write 2,70,000. What is BFO? 2,70,000. AHR, SO. Anything can be taken. I think I will be taking SO. What is SO? All of you, what is SO? 28,000 units. In how much rupees here? 9 rupees. Okay. Now, 25,000 into 9 gives you 2,25,000. Next is what? 2,70,000. 2,70,000. And then 2,52,000. 2,52,000. Can I proceed? Next. Step 2 or step 3? Step 3. Variance calculation. Step 3, variance calculation. Center, fixed overhead cost variance. The classroom, please write FO for fixed overheads to save time. Okay, fixed overhead cost variance. Fixed overhead cost variance. Formula 1 minus 2. Fixed overhead cost variance formula 1 minus 2. Tell me what is 1 minus 2? 45,000 adverse. 45,000 adverse. Tell me what is this 45,000 adverse? One name, English word, name. What is that? Under absorption. I spent how much? 2,70,000. In my cost sheet, how much I written? 2,25,000. I absorbed 2,25,000. I spent how much? 2,70,000. That's an under absorption. Yes or no? Branch it into 2. Fixed overhead expenditure variance. Fixed overhead volume variance. Branch it into 2. Fixed overhead expenditure variance. Fixed overhead volume variance. Fixed overhead expenditure variance, fixed overhead volume variance. Expenditure variance 3 minus 2. Expenditure variance 3 minus 2. Don't use calculator. What is the number? 0. Okay. 1 minus 3 volume variance. Volume variance is 1 minus 3. For volume variance 45,000. Volume branched into 2. Volume branched into 2. What are the two branches of volume variance? Capacity variance, efficiency variance. Fixed overhead capacity variance, fixed overhead efficiency variance. Fixed overhead capacity variance, fixed overhead efficiency variance. What is capacity variance? 4 minus 3. 2,52,000 minus 2,70,000. What is capacity variance? 18,000 adverse. Capacity variance 18,000 adverse. Efficiency variance 1 minus 4. What is 1 minus 4? 27,000 adverse. 1 minus 4, 27,000 adverse. So 27,000 adverse. Now, just to understand the meaning, let us discuss and then go for the main statement. Tell me, I have spent how much rupees? 2,70,000. I absorbed how much? 2,25,000. What is happening here? Under absorption. Why under absorption happens? Answer. Because I use standard rate and not the actual rate. I am just once again, F4 variance alone, I am just once again reaffirming our discussion here. Please listen, because I am going to have lot of this impact in the later stages. That's why I am repeating once again. Now, I have underabsorbed. Why underabsorption take place? I did not charge to the output 25,000 units output. I did not charge using the actual fixed overheads per unit. I charge using what? Budgeted fixed overheads per unit. Response yes or no? I use a budgeted rate for charging and not what? Actual rate. Since using SR and AR difference, the underabsorption overabsorption arises. Yes or no? What is standard rate? BFO by BO. What is actual rate? What is the actual idea? AFO by AO. Ennappa right or not? Now, in that case, standard rate and actual rate are different because of numerator BFO and AFO, or because of what? Denominator BO and AO. Yes or no? In this case, is a numerator difference there or no? I plan to spend 2,70,000. I also spend what? 2,70,000. Due to the expenditure, the underabsorption or overabsorption did not occur. Yes or no? Why it occurred? Due to volume. I plan to produce how many units? I plan to produce how many units here? 30,000. How many units here? 30,000. Look at the I plan to produce how many units? 13,000. I produce only how many units? That means 5,000 units I produce less or not? When I produce 5,000 units less, I absorb also what? 5,000 units less. Yes or no? Suppose I don't produce at all, I absorb 0 rest. Only when a mouse is produced, the mouse can take in it the fixed cost. So no, the absorption take place as and when the units gets produced. One mouse produced, how much charge? 9 rupees. Two mouse, how much charge? 18. And so on. At the end of there, I have produced how many units? 25,000 units. All the mouses have taken into it. How much fixed cost? 2,25,000. What I have spent is how much? 2,70,000. Why it has taken lesser fixed cost? Because I plan to absorb the overheads over 30,000 units, but I could absorb only how many units here? 25, because 5,000 units has been lost due to volume. So the volume drop results in what? Under absorption. Suppose I produce 35,000 units, what happens here? Volume increases, I end up with the over absorption. Now, the volume 5,000 units have dropped or not? Person may ask us, why is that the volume has dropped? Question arises, no. Why is the volume has dropped? Two reasons. Capacity, efficiency. Look at this. I plan to work how many hours? Look at the sheet here. Look at my pen also. You can understand. I plan to work how many hours? 15,000. Budget says I am going to work how many hours? 15,000. Actually, the factory worked only how many hours? 14. Did they use the full budgeted capacity? Yeah. How many hours last? 1,000 hours last. Every half an hour, 1 unit. Yes or no? 1,000 hours, how many units here? 2,000 units. I lost 2,000 units due to capacity underutilization. Yes, yes or no? Yes, next. In the 14,000 hours also, they do 14,000 hours job? No. I did only what? 12,500 hours job. I lost how many hours here? 1,500 hours due to what? Inefficiency. Yes or no? 1,500 hours could have produced how many units here? 3,000 units. So, I had 30,000 units planned. I produced only what? 25,000. There was a drop in how many units? 5,000. Why the 5,000 has dropped? Due to capacity, I dropped how many units? 3,000. So I said 2,000. Due to inefficiency, 3,000. So this 2,000 units into 9 rupees. 9 rupees gives you how much? 18,000 rupees. Advance is what variance? Capacity variance. And this 3,000 into 9 gives you what? 27,000. Advance is what? Efficiency variance. Everybody, are you following or not? Correct, huh? I am repeating this for the second time, analyzing the variance, volume drop into capacity, and then what? Efficiency. Respond yes or no. No need to have the notes for that, just only for you to understand it. Can I proceed further? Now, next. With this, we have completed all the cost variances. In one sum, we saw how to calculate material, labor, variable, and fixed overhead variances. Can I go to the next stage or not? Problem over or not over? What they ask you to do? Reconcile. They ask you to do what? Reconcile. The next step is what? We cannot do reconciliation because I know the variance. I should know what should be reconciled. I should know the standard as well as what? Actual cost. Then only reconciliation should be made. Yeah, I should know two numbers for me to reconcile not. So now I have to find out the standard cost as well as what? Actual cost, and then only go for reconciliation. Right or not? Yeah, to know that is marriage date fixed. Yeah, what you should know? Who are getting married? You should know the names are not same way. All variances are ready in hand. I should have the numbers to reconcile not. You have the budgeted as well as what? Actual. Let's find out that first and then proceed further. Can we start or not? Now, here, no need to copy. Just participate. One or two issues I want to discuss, and then I'll give you time to copy. Can you start or not? Please. Okay. Computation of standard cost per unit. Don't copy anything. Please participate. See, at the time of preparing budget, for every unit produced, I fix a target cost. I fix a target cost of producing each and every unit or not. That we call as what? Yeah? Standard cost per unit. This number I get from actuals or budget. Budget. Okay. Tell me one by one. Budget says to produce every unit, how many kg metal can be used? Everybody I want to involve. How many kg can be used here? 3 kg. Budget says your purchase manager should purchase every kg. How much rupees? So budget says for every unit to be produced, you can spend how much more material here? 13.2 is the allowed material cost for every unit produced. Yes or no? Yes, to produce every unit, how many hours labor time can be taken? Half an hour. Yes or no? And every hour, my HR can pay how much as the wages? 5 rupees. So they say the target wage cost for every unit to be produced is how much rupees here? 2.5. Variable overheads, already find out SR. Okay, the budget says for every unit produced, the variable cost should be how much here? 6 rupees. Yeah, the SR per unit already calculated. I need not explain once again. And it says for every unit produced, I should absorb. I should what? Absorb. How much rupees here? 3 rupees. 9 rupees. Okay, these are all the targets set by the budget. I may accomplish, I may not. A different issue. Okay, that means budget says to produce a unit, I am allowed to spend how much rupees? Like clarity. So at the beginning of the video I said every mouse or every unit produced I have to charge how much? I have to spend how much rupees? 30.7. If I spend more, the variance becomes what? Adverse. If I spend less, it becomes what? Favorable. Everybody, right or not? Okay. Now, how many units I plan to produce? How many units here? 30,000. If the 30,000 units I multiply by what? 30.7, I get budgeted cost. Everybody, yes or no? I plan to produce 30,000 units or not? I plan to produce 30,000. I plan to spend what? 30.7. 30,000 into what? 30.7. Some number you tell me. What is that here? 9 lakhs? 9 lakhs? 21,000. 9 lakh 21,000 rupees is the cost I plan to spend. Yes or no? Yes, next is, how many units I actually produce? 25,000 units. That 25,000 units is the actual output. If you multiply by what? 30.7. I get what cost here? Standard cost. Yes or no? Or else following what I am saying, I get what cost here? Standard cost. Every unit 30.7 allowed. I produce how many units here? 25,000. For the 25,000 units produced, I am allowed to spend how much here? 25,000 into 30.7. Tell me a number. What is the number? 9 lakh? 7 lakh 60? 500. 7 lakh 67,500 is the cost allowed. Respond, yes or no? And I actually spent some money or not? That we call as what? The cost incurred. I don't know. There are 3 costs here. Budgeted output 30,000 into budgeted cost is going to give you what? Budgeted cost. Actual output 25,000 into budgeted cost gives you what? Standard cost. And what I spent is what? Actual cost. I should reconcile budgeted cost and actual cost. Standard and actual. I cannot compare a target cost of 30,000 units with the actual cost of what? 25,000. Obviously, actual will be less only. I should compare the target cost for the actual output 25,000 units with what? The actual cost to properly understand the variances. Right or not? Now. So, now I require for my reconciliation what cost? Standard cost. Tell me what is the actual output? 25,000. What is the standard cost per unit? 30.7. What the standard cost is said? 7,67,500. Everybody following what I am saying or not? Okay. Now, I just want you to do one thing for me. Please. What is standard cost now? 7,67,500. You calculated all the variances now. Yes, in metal variance, what is first column? SQ into SP. Labor variance, what is the first column? SS into SR. Variable, what is the first column? SH into SRR, AO into SR. What fixed is first column? SH into SRR, AO into SR. The first column in all the variances represents standard cost. What cost is standard cost? What is the second column material variance? AQ into AP. Labor variance, what is the second column? AH into AR. Variable overheads, AVO. Fixed overheads, AFO. Second column represents what? Actual cost. First column is standard cost. Second column is what? Actual cost. Difference is cost variance. Yes or no? No. Can we check it or not? No. Please take the notebook and please tell me the first column in each and every variance. So I want to have the standard cost. You have to tell me the first column. Okay. Material. What is SH into SR? 3 lakhs 30,000. Okay, 3 lakh 30,000. Next, labor, what is the first column? 62,500. Now, variable overheads, what is the first column? 1 lakh. First column is 1 lakh 50,000. Fixed overheads, what is the first column? 2 lakh 25,000. Can you total me what is the total? 7,67,500. Tell me, this number is budgeted cost or standard cost? Because the per unit is what? Budget. But the output I use throughout is what? Actual output. Standard hours for actual output. Standard quantity for actual output. AO into SR. And wherever I use it for what? Actual output. This 767,500 is not a budgeted cost. It's only one cost here, standard cost. So cost variance, I am not comparing budget and actual. I am comparing only what? Standard cost and actual cost. Are you getting the confirmation or not? Can I proceed further? Now, next. Okay. So, 7,605 rupees is what? Standard cost. Next, actual cost. Now, you need not search everywhere. Second column in what? Every variance gives you the actual cost. Please tell me the number here. Material, what actual cost? 3,36,000. Labor, AH into AR, what the actual cost? 75,600. Variable overheads, what the actual cost? 1,60,000. Fixed overheads, what the actual cost? 2,70,000. The actual cost spent is how much? 8,41,600. 8,41,600. Can I proceed or not? No. I'll give you time to copy. Please participate. 841,600. Now, first, I'll have three costs. That is a budgeted cost. That is what cost here? Budgeted cost. Which I calculate as 30,000 units into, what is the standard per unit? 30.7? Okay, 30.7. What is the budgeted cost? Tell me. 9 lakh? Budgeted cost is 9,21,000. Next is standard cost. I find it as 7,67,500. Next is what? Actual cost. Now find as 8,41,600. Ennappa right or not? No. I plan to spend 9,21,000. I spent how much? 8,41,600. I saved a cost. Cost variance favorable. True or false? I planned to spend at the beginning of the period. I wanted to spend how much rupees? 9,21,000. I spent only what? 8,41,600. I saved cost from the company. Cost variance favorable. True or false? Why false? This is the target cost. If I had produced what? 30,000. I produced only how much? That means my cost already is only how much? 7,67,500. I should not compare 921 but 841,600. I have to compare what? 761 with what? 841,600. For my 25,000 units, I should have spent 767,500. I have spent 841,600. Cost variance favorable, adverse, adverse. Why it is adverse? We saw the reason: material price, material usage, labor rate, labor efficiency, VO expenditure, VO efficiency, FO expenditure, FO capacity, FO efficiency. All variance we calculate or not. That gives a detailed breakup of why the cost has differed. Everybody following? That we present in form of what statement? Reconciliation statement. Can I move to the reconciliation statement or not? No. That's a very simple affair. Now, reconciling between what and what cost? Standard cost and actual cost. Okay. Tell me, standard cost. Just now we calculated 7,67,500. Now, variances. I have favorable as well as what? Adverse. Listen here. When I write the breakup, I should not write the total. Material variance, cost variance, price variance, usage. Three variance we calculated or not? Yes, sir. I should not write all the three. Then I will be accounting for variance two times. Yeah, correct? Yes, suppose cost variance 10,000, price variance 8,000, usage is what? 2,000. If I write all the three, I will be accounting 20,000 rupees variance. Yeah, correct? Yes, When you write the total, don't write the breakup. When you write the breakup, don't write what? Total. When you write price and usage, you should not write what? Cost. Because the cost breakup only is what? Price and usage. Isn't it correct? So if you either write the total or write what? Breakup. Don't write both. I'll be accounting for variance two times. Correct? Simple logic. So write the total or breakup. If we want to write the total, I can say standard cost and actual cost is variance. I am calculating all this because to show in as much detail as what possible. Always you should write the utmost breakup for what? Every variance. Don't write the total. Always write what? The breakup. Right or not? Now, please tell me one by one. Material cost will be written or will not be written or will not be. Tell me material price variance. Look at the notebook and tell me favorable or adverse. How much favorable? 16,000 favorable. You should tell me. Next is what? Material usage variance. Favorable or adverse? How much adverse? 22,000. Labor cost will be written or will not be written or will not be written. Labor rate variance. Favorable or adverse? How much adverse? Okay. Labor efficiency variance is favorable or adverse? Adverse. How much adverse? 7,500. Variable overhead cost variance will be written or will not be written or will not be written. So variable overhead expenditure. What is the variance? 8,000 favorable. VO efficiency variance. Favorable or adverse? How much adverse? 18,000. Now, fixed overhead cost variance will be written or will not be written or will not be written. So, fixed overhead expenditure variance is what? 0. I will write 0. Will I write fixed overhead volume variance or will not write? Will not write. His breakup is what? Capacity and efficiency. FO capacity is how much here? 18,000. Efficiency is how much? All variance have been written or not? Now, tell me what is the favorable variance total? 24,000. Adverse variance total is 22,000 plus 5,600 plus 7,500 plus 18,000 plus 18,000 plus 27,000. I am not dictating you. Do it. Yeah, tell me what is the number? 98,100. Net favorable, net adverse. How much net adverse? 74,100. Adverse variances is going to increase the cost or decrease the cost or increase the cost. I plan to spend 767,500. I spend less or more or more. How much to pay? 74,100. What is the actual cost I spent here? 8,41,600 is the reconciliation of standard cost and actual cost. Everybody have the clarity or not? Yes. Nothing to clap, yeah. What is that we want? Bifurcate, reconcile. That's all. Okay, no new concept. Are you following or not? No. So, this is how one should reconcile a standard cost and then what? Actual cost. Now, from this, reconciliation nothing great. But what we can understand is that three costs: budgeted cost, standard cost, actual cost. In the big way we understood how these three costs are calculated, right or not? And I am not reconciling the cost variance budget and actual. I am reconciling what? Standard and actual. Always prove through this particular slide. Yes or no? I did not reconcile 9,21,000 and then what? 841,600. I reconciled only 7,61,500 and this number. So all our cost variances are comparing only standard cost and actual cost. Column 1 is what cost? Standard cost. And column 2 is actual cost. Third column, fourth column and all is given only to give the breakup of what? The variances. Everybody following or not? Now, from where should you copy? Okay. Part 3 or part 4 or part 5? Okay, part 5. Right, part 5. Computation of. Part 5. Computation of standard cost and actual cost. Computation of standard cost and actual cost. Computation of standard cost and actual cost. Can I proceed? Step 1. Standard cost per unit. Finish copying, huh? Okay. Those who are not copy, raise your hand. Shall I proceed? Madam. Step 2. Computation of standard cost. Step 2. Computation of standard cost. Computation of standard cost. So if you want in bracket write, what is standard cost? Standard cost for actual output. Computation of standard cost. In bracket write standard cost for actual output. Finish copying. The ஒண்ணுமே இல்லை இந்த ஸ்லைடில் ஆக்சுவல் அவுட்புட் 25,000. A single line எழுதலாம் 25,000 units into 30.7 is equal to 767,500 is what is the content of the slide. Over and down, right down. Same step, right? Alternatively, standard cost is the total of standard cost is the total of column 1 in all the variances. Alternatively, standard cost is the total of column 1 in all the variances. Is total of column 1 in all the variances. Can I proceed? No. Particulars, amount. I have two columns, particulars, amount. Material 3,30,000. Material 3,30,000. Labor 62,500. Material 3,30,000. Labor 62,500. Variable overheads 1,50,000. Variable overheads 1,50,000. Fixed overheads 2,25,000. Fixed overheads 2,25,000. Total is 7,67,500. Total 7,67,500. 7,67,500. Respond yes or no now. Step 2 or step 3? Step 3. Computation of actual cost. Computation of actual cost. Unlike that. Right. Actual cost is column 2 total. Actual cost is column 2 total in all variances. Actual cost is column 2 total in all variances. Actual cost is column 2 total in all variances. Please copy this slide quickly. Finish copying up. Shall I proceed? Write down note. Write down note. Just for our clarity, okay? Write down note. There are 3 types of cost. Note, right? There are 3 types of cost. Branch it into 3. Branch it into 3. Can you name the three types of cost? Budgeted cost, standard cost, actual cost. Budgeted cost, standard cost, actual cost. Budgeted cost, right? 30,000 units into 30.7. I plan to produce 30,000 units. I plan to spend 30.7 per unit. 30,000 units into 30.7 is equal to how much rupees? 9,21,000. 9,21,000. Standard cost 25,000 units into 30.7. Standard cost 25,000 units into 30.7. 30.7 is budget, but the unit is what? Actual. So is equal to how much rupees? 767,500. Actual cost 8,41,600. Actual cost 8,41,600. This is point 1 in the notes. Okay, there are three types of cost. Point number 2. We should not compare the target cost for 30,000 units. We should not compare the target cost for 30,000 units, that is rupees 9,21,000. We should not compare the target cost of 30,000 units, that is rupees 9,21,000, with actual cost spent for how many units? 25,000 units. With actual cost spent for 25,000 units, that is 8,41,600. 8,41,600. The right way is to compare the revised target. The right way is to compare the revised target of rupees 767,500. The right way is to compare the revised target of rupees 767,500. I revised my target from a new output, yes or no? The revised target rupees 767,500 with what? Actual. The revised target of 767,500 with actual. With actual. Now are you all following or not? Last part. Part 5 or part 6? Part 6. Reconciliation statement. Reconciliation statement or reconciliation between standard cost and actual cost. Reconciliation between standard cost and actual cost. Reconciliation between standard cost and actual cost. Okay. Please copy this quickly. When you prepare, write the breakups, don't write the total. Don't write both, because in that case we will be accounting for the variance 2 times. Okay. Why the adverse 74,100 has been added to the cost? Adverse variance increases the cost. 767,500 cost is increased due to adverse variance to become 841,600. Favorable variance means what? Savings in cost. You should have been reduced from what? Standard to have an actual cost. Understood? Those not copy, raise your hand. Those who are not copied, please raise your hand. Finish copying up? Now. With this, we have completed stage 1 of this chapter, namely learning to calculate all the cost variances. Okay. See, stop talking, please. I am just stopping this chapter. I move to one area outside this chapter and then come back. Okay. Don't think that I am just deviating from the topic. The discussion is required for me to continue the chapter further. The area we are going to discuss is called as marginal costing versus absorption costing system. Please. This is a topic that needs to be covered in the chapter marginal costing, but we are covering it here because when I do reconciliation, these concepts are very, very important to understand. So now we are going to discuss about a concept called as marginal costing versus absorption costing. Not that what we discuss in marginal costing versus absorption costing is final, because I will do this marginal costing versus absorption costing once again in what? Marginal costing chapter with some advanced issues like marginal costing break-even point, absorption costing break-even point, stock valuation differences, etc. later. But I am going to discuss that now. I will continue this concept further in what? Marginal costing. So this part alone, we are having a break-up in discussion where I discuss marginal costing versus absorption costing in standard costing chapter also. I continue in what? Marginal costing later. I stop the variance now. I come to marginal costing. I continue with the variance discussion once I complete this area marginal costing versus absorption costing. Here I require you to do me one favor. Now I teach marginal costing versus absorption costing. I spend 1 to 1.5 hours in completing this. Understood? Now, I teach it now or not? You should not make me teach all this once again during marginal costing chapter. Now, don't shout here. Then it's like recording variances 2 times. Same way. I cannot teach the same thing once again. At that time, I start from where I left. I start from what? Where I left. I am going to do a 5-minute summary. I cannot once again what? Redo the portions. And this you should help me to always have a grip. It's a very important area. It's not new to you. This I have already discussed in IPCC also. You know what the main problem is? I do it in IPCC. I have to do it in what? Final also. And now, final don't make me do it 2 times. Next time when I continue in marginal costing, you should allow me to what? Continue from where I left, not to start from beginning. On that day I said na, then you look at me blank. Then I have to start once again what? Discussing. Don't put me in that particular position. Yeah, please. So give the heading marginal costing versus absorption costing. Stop talking, please. I will have a lengthy introduction for this. I'll give the notes for the introduction also. We'll do a problem in this regard where we'll reconcile the marginal costing profit and absorption costing profit, make some observations very important, and then come back to the standard costing. Okay, now let's start with the introduction now, please. Okay. Think afresh. I am going to start from the scratch for you to understand it. Tell me, sales is equal, profit is equal to what? Sales minus cost. It is wrong. Sales minus expired cost will be called as what? Profit. Tell me, profit is equal to what? Sales minus expired cost is equal to profit. Listen here, please. In your trading and P&L account, we credit sales. We debit all the expenditure. Sales minus all expenses profit. No. Because a part of the expenses you credit back as stock and take it to the next period. First settle down. See, listen carefully. Simple area only, but always students find this to be difficult. That's why I am discussing elaborately this area. Listen. Sales minus cost is not profit. Profit is not what? Sales minus cost. Because whatever debit this year cost will not remain in this year. A portion of the cost are transferred to next year via stock. I debit all the expenses. I credit closing stock or not. What is closing stock? It is also cost only. A part of the current year cost goes to what? Closing stock and get transferred to the next year. Are you following not? That means sales minus cost is not profit. Sales minus what? Expired cost. The question is, sir, what is expired cost? Question is no. Expired cost means those costs which are charged against current year sales are called as what? Expired cost. Then what is unexpired cost? Those costs which goes to the next year are called as what? Unexpired cost. Enna paraida? Tell me, what is expired cost? Those costs which are charged against the current year sale. The cost will live for one more year, dying this year. I put it into the mouth of the sales this year itself. So no, it becomes what? Expired cost. And some costs live for one more year or not. They go through stock to the next year. Those costs are called as what? Unexpired cost. Expired costs are netted off against the current year revenue. Unexpired cost is going to be get carried forward to what? Next year. Is what we mean by expired cost and unexpired cost. Everybody following, huh? Next is. So what cost expires, what cost do not expire? Next question arises, no? Now, here I make a very important classification which will do in most of the future chapters. It is called as product cost and then period cost. What are two costs here? Product cost and then what? Period cost. What is product cost and what is period cost? Those costs which I can consider for stock evaluation, which I consider for what? Stock evaluation is called as what cost? Product cost. Those costs which are ignored, which are what? Ignored for stock valuation are called as what cost here? Period cost. For example, mouse is produced. What is produced here? Mouse is produced. This mouse is now say it has been produced. I have spent some cost to produce it or not. What happens is, if the mouse is sold, that cost becomes cost of goods sold. If the mouse is not sold, it becomes a closing stock. That's simple, right or not? Now, in that case, I should value the stock of this mouse, right or not? Now, in that, will the mouse cost include material cost? The manufacturing labor? The overheads, power, other overheads or not? Yes. Will it include an administration cost? Will it include selling expense? No. Because administration selling expense, just to crudely say, is debited in P&L, not debited in what? Trading. What gets debited in trading only can go to closing stock valuation. What comes in P&L will not go for what? Stock valuation. Are you following or not? I don't value stock at full cost. I value stock only at manufacturing cost. Everybody, yes or no? Non-manufacturing cost. Examples are administration and selling. Salesman commission will not go for stock valuation. Right or not? Advertisement expense will not go for what? Stock valuation. But the manufacturing labor, your raw material cost, your power cost of manufacturing, all goes for what? Stock valuation. So I simply say, whatever cost will be considered to value my stock, I call as what cost? Product cost. Whatever cost I don't consider for value my stock is called as what? Period cost. Innappa, yes or no? Now, I don't produce any units at all. I don't produce what? Any units at all. I spend administration, selling, all expenses. I don't sell also. Tell me, will the period cost be debited in this year account or not? Yes. The period cost always expires. The period cost always what? Expires fully. It always expires what? Fully. Whether I sell those units or don't sell those units, I'm not worried. Even if gross profit is zero, I debit what? All the office and admin selling expenses. Everybody follow not? So period cost expires what? Fully. It won't go to next year any part. Are you following? Huh? But regarding product cost, what happens is, it is going to be branched into two. Cost of goods sold and then what? Closing stock. I incur manufacturing costs. When the mouse is sold, that becomes what? Cost of goods sold. Expires in the same year. If the mouse is not sold, it goes to what? Next year through the closing stock. Are you following not? So, in case of product cost, they expire to the extent of what? Cost of goods sold. If the product, say, goods are not sold, the product cost expires this year, goes next year, go to next year. It becomes what? Unexpired cost. Everybody, are you following what I am saying? So, what is profit? Sales minus expired cost. What cost expires? Period cost expires fully. Administration selling expenses spent this year will be fully evident in what? This year P&L. No part of the administration goes to next year. No part of selling expense goes to what? Next year. So the period cost, which are non-manufacturing cost, expires what? Fully. Product cost expires only to the extent of what? Goods sold. I spent 10 lakh rupees to manufacture 10,000 units. How many units here? 10,000 units. In that I sold how many units? 8,000. And 2,000 units is what? Unsold. In that 8,000 units relevant cost is what? 8 lakhs is going to expire in the current year. And 2,000 units cost goes to what? Next year. The 8,000 units cost I call as what? Cost of goods sold. And 2,000 I call as what? Closing stock. So product cost goes to next year to the extent of what? Closing stock value. And stays in the current year, gets netted off against revenue to the extent of what? Cost of goods sold is what is the cost classification. Are you following? Yes, okay. Just to get a confirmation, say profit is equal to what? Sales minus expired cost. What cost expires? Period cost expires fully. Product cost expires to the extent of what? Goods sold. Product cost goes to next year. To the extent of what? Closing stock is the issue. Are you following? Not? Another question is, sir, how to know whether a cost is product cost or period cost? Above that, I am going to discuss now in the marginal costing versus absorption costing. Can you go to the next stage of discussion or not? No. See, company spends cost. Varieties of costs are spent in the year. They pay for materials. They incur printing and stationery. They have advertisement. They have auditor fees. So they have what? The workman wages. They incur power costs, factory rent, office rent, warehouse rent. So many costs incurred or not? All the costs spent by the company, I thus simply classify into two types. I classify into how many types here? Two types. Those costs which are spent in factory for manufacturing, I call as what cost here? Manufacturing costs. And all the other costs, I call as what? Non-manufacturing costs. Every cost spent by the company can be easily categorized into two types: manufacturing costs, non-manufacturing costs. Examples of non-manufacturing costs are administration expenses and then what? Selling expenses. To crudely say, whatever debit in P and that, I call as what? Non-manufacturing cost. What debit in trading, I call as what? Manufacturing cost. Or to understand, I am saying not formally. Everybody following not? No. So, non-manufacturing costs are what and what? Administration and selling expenses, and all the manufacturing expenses are manufacturing costs. Respond yes or no? No. This manufacturing cost I further classify into three. I further classify into what? Three. Material, labor, overheads. Material, labor and then overheads. All they are spent inside factory. The overheads are further classified into two: variable and then what? Fixed overheads. Up to this, are you following or not? No. First, all non-manufacturing costs are always period costs. They are always what costs here? Period costs. It may be variable, it may be what? Fixed. Salesman commission, variable or fixed? Advertisement, variable or fixed? Fixed. Fixed or not? No. So advertisement does not depend upon the unit sold, yes or no? So salesman commission is a variable selling expense. Advertisement is what? A fixed selling expense. Tell me, variable selling expense will go for stock valuation, will not go. Fixed selling expense also not go for the stock valuation. So whether it is variable or fixed, I don't worry. If a cost is non-manufacturing, the cost is always what? Period cost. Point number one, over. Yes or no? And manufacturing costs, material, labor, variable overheads. I just clarify these three: material, labor and variable overheads are product cost. Or what cost here? Product cost. Okay, this material, labor and then what? Variable overheads are what cost here? Product cost. There will be always concern for what? Stock valuation. The controversy is regarding what? Fixed manufacturing overheads. Controversy regarding what? Fixed manufacturing overheads. Is fixed manufacturing overheads to be considered to value my stock or should not be considered is the issue. discussion here. So, very simple. To produce a mouse, I spend material. Will you go to stock value? To produce a mouse, I pay wages. Will you go for stock value? To produce a mouse, I incur power cost. Will you go for stock value? Yes or no? To sell the mouse, I incur selling expense. Will you go to stock valuation? No. To do all this, I have an administration office. I pay what? Salaries. Will go to stock value? No. That means, surely, mouse cost will never have administration, selling expenses. Mouse cost will surely have what? Material, labor, wage overheads. The question is, should the mouse cost for stock valuation include a portion of the factory rent? I'm just giving an example. A fixed cost is what? Factory rent. Let's take a factory rent. Should a share of factory rent be given to every mouse produced for stock valuation? Question arises. Any question? Yes is what absorption costing says. No is what marginal costing says. That is, the fixed manufacturing overhead is going to be called as product cost under what system? Absorption costing system will be called as what cost here? Period cost. Under what system? Marginal costing system. Everybody following my discussion or not? That means when I prepare my P&L account, when I prepare my what? P&L account under marginal costing system, my closing stock will not consist of a share of fixed cost. I don't know. But if I prepare under what? Absorption costing system, a share of fixed manufacturing cost also should be going for what? Stock valuation. Is the main difference between a marginal cost system and absorption cost system. This is going to be the point of difference. Yes or no? This is going to give you very interesting calculations in marginal costing chapter later. But this is the main difference between what? A income statement or a profit and loss account prepared under marginal costing and what? Absorption costing system. Point number one. Are you following or not? Okay. Tell me. Stock should be valued at total cost. True or false? True or false? False. Stock should not. First, stock should be valued at selling price. True or false? It should not consist of what? Profit. Stock should be valued at total cost. True or false? False. In a stock value should not consist of what? Non-manufacturing cost. Stock should be valued at manufacturing cost. True or false? It is true for absorption costing, false for marginal costing. In absorption costing, I value my stock at full manufacturing cost. I will stock at what cost here? Full manufacturing cost. In marginal costing, the same stock will be valued at what cost here? Variable manufacturing cost. Everybody, yes or no? So the difference between marginal absorption is on stock valuation, marginal values the stock at what? Variable manufacturing cost. Absorption at what? Full manufacturing cost. The full manufacturing cost includes what? Unitized fixed cost also. Innapa, right or not? The next issue of discussion. So, stock valuation is done at variable manufacturing cost under marginal and full manufacturing cost under what? Fixed. I use normally throughout my classes VMC for what? Variable manufacturing cost. FMC for what? Fixed illaya. FMC for what? Full manufacturing cost. In my son no. So it is variable manufacturing cost and then what? Full manufacturing cost. I use VMC and then FMC. Fixed I use as FM words. Means what? Fixed manufacturing overhead to differentiate. Can I proceed or not? No. Next. The question is marginal costing clean. No controversy. Because it values at what cost here? Variable cost. To produce a mouse, easily I can find out material inside it. Can easily find out what? Labor. As well as what? Variable overheads. Because they are incurred directly. But to give a common fixed cost to every unit is a challenge that has to be done in absorption costing. Marginal costing, fixed cost, no headache. I take the total, add it to what? Administration selling, debit in what? P&L account. I don't have a headache. The problem arises only in what system? Absorption costing. In absorption costing, I should find out the fixed cost per unit. I should find out fixed cost per unit or not, because only when I find out fixed cost per unit, if the unit is sold, it becomes what? Cost of goods sold. Not sold can become what? Closing stock. I am forced to unitize a cost which should not be unitized. Your room rent is never incurred per unit. Your room rent is never incurred what? Per unit. But still, I have to make the room rent per unit. Why I am forced to make room rent per unit? Because I have to value my stock by giving per unit room rent also. Yes or no? That means I am in a difficult position where a cost which is not unitized should be made what? Unitized. How to charge fixed cost per unit is the next stage of discussion, absorption costing. Everybody following? Yes, sir. Now, here there are two ways. At the end of the year, I will calculate what the actual room rent paid. Correct? At the end of the year, I total how many units are produced. Suppose at the end of the year, I pay 4 lakh rupees room rent. Okay, I produce suppose 1000 units. Okay, so tell me 4 lakhs divided by what? 1000. I charge 400 rupees as what? Room rent. It is called as charging using actual. But can I do so? Not possible because that I know only on 31st December. Accounting year 31st March. I know only at the end of the year. Till then I don't know how many units have been produced. So I cannot wait to value my stock or do the costing process till the year end. It should be a continuous process. Accountancy is not continuous. There's only what? A period base. Costing is what? Continuous. The costing, cost ledger accounting, we see in the backflash costing later, is a continuous process where I should value my stock on daily basis as and when the unit gets what? Produced. Are you following? In that case, I cannot charge fixed cost per unit actual. I should charge only what? Budgeted. Because that is what is available at the beginning. So what I do is, in the beginning of the year, I estimate. For example, let's take MTH, no stock, just for imagination. Okay. Beginning of the year, I estimate what will be the room rent. What will be what? Room rent. It's called as BFO. BFO means what? Budgeted fixed overhead. I also estimate the volume, which I call as what? BO. Call as what? Budgeted output. Suppose I budget the fixed cost to be 4 lakh, I budget the output to be 400. That means I say I am going to charge how much per unit? 1000 per unit as what? Room rent. So no. Now every unit produced, I charge how much units here? How much rupees? 1000. At the end of the year, when every mouse gets produced, it will absorb what? A fixed cost of 1000. Is or no? At the end of the year, I don't produce 400 mouse, I produce what? 500 mouse. Means the mouse will be taking into it how much fixed cost? 5 lakh. But what I spend is only how much? 4 lakh. The 1 lakh will be called as what? Over absorption. Suppose I produce only 300 mouses, I spend 4 lakh, I absorb only what? 3 lakh, and that 1 lakh is called as what? Under absorption. So what happens is, to every unit produced, I give material, I give labor, I give variable overheads. I also charge what? Budgeted fixed overhead. I charge what fixed overheads? Yeah? Budgeted fixed. I don't charge using actual rate. I charge using what? Standard rate. AO into SR. Already discussed in FO variance. Yes or no? No. At the end of the year, what I have charged is AO into SR, which I call as what overheads? Absorbed overheads. What I have actually spent, which I call as what? Actual overheads. The difference we call as what? Under over absorption. That should be adjusted in my P&L account to calculate the right profit or absorption costing system. Right or not? Marginally, this problem does not arise. There is going to be no under absorption or over absorption because I never unitize my fixed cost. Are you following? What I actually spent, I added and what? Debited in the P&L account. That's all. This is regarding the marginal costing and absorption costing stage 2 discussion. Any okay. Tell me, I charge fixed cost to the every unit produced using what rate? Budgeted rate. Can also be called as what? Standard rate. CA-IPCC we call as predetermined rate. I charge using what? A predetermined rate. What is the budget rate formula? BFO divided by BO. What is BFO? Budgeted fixed overhead. What is BO? Budgeted output is denominator activity. The denominator activity is 100% capacity, normal capacity. Because I don't budget abnormally, I budget only what? Normally. So generally the word budgeted output should be understood to be what capacity? Normal capacity. If they don't give normal capacity, give only what? 100% capacity, then I assume that the 100% capacity itself is what? Normal. For example, MTH room, 100% capacity is what? 800. They don't say normally 600 students. That things it means what? Always, how many students comes here? 800 comes, maybe the assumption. Everybody follow what I am saying? In that case, I should use BO as what capacity? Normal capacity. In the absence of information in the question, I should use it as what capacity? 100% capacity. Numerator is what? BFO. There's also something called AFO. What is AFO? Actual fixed overhead. If they don't give actual fixed overhead, then what? It is same as BFO. These two assumptions one should make when the information is not available. That is a right assumption, nothing wrong in it. Are you following what I am saying? So this is the second stage of discussion. Lastly, I have to give you the format for what? Marginal costing and absorption costing income statement. I'll discuss that format and give you the notes in this regard. Then we can just go for the problem involving margin versus absorption. Then come back to the standard costing chapter. Till now what I am discussing, are you following? First of all, profit is equal to what? Sales minus expired cost. All costs expires. No. We classify cost into two types. What two types? Product cost, period cost. What is product cost? Considered for stock valuation. What is period cost? Not considered for stock valuation. Period cost expires fully. Product cost expires to the extent of cost of goods sold. Does not expire to the extent of the closing stock. Yes or no? No. The question, sir, what is then product cost? What is then period cost? So, because product costs are considered for stock valuation, period are what? Ignore. What should be considered? What should be ignored is the next issue. So, we classify the cost into two types. What two types of cost? Manufacturing, non-manufacturing. Non-manufacturing costs are always what? Period cost. Whether they are variable or fixed. Manufacturing further classified into material overheads. What are further classified into variable and fixed overheads. Okay, the labor is always assumed to be variable labor in our chapter. Now, in that case, now tell me, the variable manufacturing costs are always what cost? Product cost. Fixed manufacturing overhead is product or period of product under absorption costing and period under marginal costing. Other words, in marginal costing system, fixed manufacturing overheads like factory rent, supervisor salary, etc. will not go for stock valuation, will go to the P&L account. Respond, yes or no? And in absorption cost system, they should be considered for stock valuation. To put it simply, absorption costing value stock at what cost? Full manufacturing cost. And marginal costing is in what cost? Variable manufacturing cost. What is variable manufacturing cost? Material, labor, variable overheads. What is full manufacturing cost? Material, labor, variable overheads and unitized fixed overheads. How do you unitize fixed overheads? Using actual rate or budgeted rate? Budgeted rate. Standard rate is equal to what by what? BFO by BO. Where the BO is what capacity? Normal capacity. And the BFO is the budgeted fixed overheads. Using the standard rate, I charge to budgeted output, actual output, actual output. The actual output takes what rate? Standard rate. What is taking the cost is actual output, but how much cost is taken is what? Standard. Ultimately, the AO into SR is the overhead charged to the products. That is called as what overheads? Absorbed overheads. What is spent, what absorbed may be same or different. The difference is called as what? Overall under absorption. That needs to be adjusted while preparing the P&L account. Everybody respond yes or no? And when they don't give you detail regarding AFO, can be assumed to be the same as what? BFO, are all in essence what has been discussed in this marginal costing versus absorption costing. Okay, now let me just write the income statement format and then I'll dictate the notes, then we can just do the problems. Okay, see. First, you need not copy. First is absorption costing income statement. Okay, see. Please don't talk. First, I am having sales. We have a number called as what? Sales. From the sales, we reduce cost of goods sold to calculate gross profit. Right or not? Yes, correct? No. What is cost of goods sold? Opening stock of finished goods. Add what? Cost of production. COP means what? Not certificate of practice. Cost of production. Minus what? Closing stock of finished goods. This number is going to give you the number called as what? Cost of goods sold. Ennappa, right or not? No. Now see, opening stock of finished goods should be valued at selling price or cost price. Should be valued at total cost of manufacturing cost. So, the total manufacturing cost, manufacturing cost. Now, the stock should not have what? Non-manufacturing cost. So, valued at full manufacturing cost or variable manufacturing cost, full manufacturing cost. Obviously, my stock is going to be valued at what? FMC means what? Full manufacturing cost. Ennappa, right or not? Now, very simple. What is cost of goods sold? Already last year I produced some units not sold, brought to this year. This is the cost of goods produced last year, brought to what? This year. And this is a current year production cost. The total gives you cost of goods available to sell. So, what is available to sell? Last year unsold units and this year produced units is going to give you what? Goods available for sale into cost gives you what? Cost of goods available for sale. Yes or no? In this minus cost of goods not sold. What is cost of goods not sold? Closing stock. What it is what? Cost of goods sold. Ennappa, right or not? Now, in this case, the opening stock and closing stock should be valued at what cost? Full manufacturing cost. When I say cost of production, in cost of production, to produce the units, I spend material cost. I should write it or not? Yes. This number will consist of material cost, it will consist of what? Labor cost, consist of what? Variable overheads, also consist of what? Absorbed fixed overheads. What fixed overheads here? Absorbed. I may pay actually 8 lakh rupees rent, but I only charge what? What is absorbed? Are you following what I mean? Because what goes into cost of production is not the actual fixed manufacturing overhead. What goes in only what? Absorbed. Because every day when I produce, the units absorb the amount and goes and sits in cost of production. Yes or no? At the end, this cost of production is accumulated continuously. Are you following what I'm saying? At the end, then I'll compare to find out what? Under absorption or over absorption. Right or not? Now, tell me the number here. Cost of production consists of what? Material consumed, the labor, the variable overheads, and absorbed fixed overheads. Because fixed overheads, I don't charge actual to the production. I charge only what? Standard rate. How many units produced? Will absorb what? Some amount. It consists of absorbed fixed overheads. That is going to give me the cost of goods sold. Response yes or no? Now, I'll continue. Point B or C? C. I get gross profit. What is gross profit? A minus B. That gives you the gross profit. Sales minus cost of goods sold. Respond. Yeah, yes or no? Now, D is, I believe, having what expenses? Administration and selling expenses. Fixed or variable or both are both. You know, after gross profit, the account is P&L account. It is not. I'm going to pay both. So, administration and selling expenses, I'm going to have. Respond, yes or no? So, gross profit minus the period cost. Namely what? Administration and selling expenses should give me the profit. Yes or no? But it will not give me actual profit because all numbers are actual except for cost of production where fixed cost is absorbed. Yes or no? There is going to be a cost that is absorbed and there is going to be a cost that is actually spent. The difference is called as what? Under absorption or over absorption. That should be adjusted to the profit or not? Yes. Then point number E is what? Plus or minus under or what? Over absorption. Under absorption means under debit. It means what? Under debit. I should once again what? Debit it. I should add or subtract from the gross profit. Over absorption means what? Over debit. What I should do? Credit back. I should be adding to what? Gross profit. There can be plus or minus under or over absorption. The balance what I get is called as what? Profit. Under what system? Absorption costing system. Respond. Are you finding the format or not? Tell me the format. Sales. Next is what? Cost of goods sold gives you gross profit minus administration and selling. Plus or minus under or over. Why this number is coming? Because inside the COP, the fixed manufacturing cost, what I debited is not actual. What I debited is only what? Absorbed. I made absorb 4 lakhs, but I actually spent what? 5 lakhs. In the gross profit, only 4 lakhs is written. Yes or no? But I should debit in my P&L. How much is 5 lakhs? The balance 1 lakh is called as what? Under absorption. Should be reduced further. If I am debiting 6 lakhs, I'll be crediting back and so on. Adjust under over absorption to find out the operating profit or profit of the company. Respond. Are you following or not? This is under what system? Absorption costing system. Now, same way, let us see how the income statement looks like under what? Marginal costing system. Okay, now, same. Capital A is what? Sales. It is going to be sales. B, what is the absorption costing system? Cost of goods sold. I call as variable cost of goods sold. Sales minus what? Variable cost of goods sold. Same thing. Opening stock of what? Finished goods and variable cost of production minus closing stock of finished goods. This is going to give me what? The variable cost of goods sold. Okay. The number comes in the outer one column. Respond yes or no? No. See, opening stock should be valued at selling price, cost price. Should be valued at total cost, manufacturing cost. Full manufacturing cost or variable manufacturing cost? Now, fixed manufacturing cost is considered to be what? Period cost will come along with administration selling. You know what I am saying? In that case, I should value my stock at what cost? VMC, variable manufacturing cost. When I say cost of production, it includes material cost of production, labor cost of production, variable overhead cost of production, fixed overhead cost of production, no. It's stated as what? Period cost along with administration and selling differently. Respond yes or no? No. So from sales, I reduce what? Variable cost of goods sold. What I get C, I call it as gross contribution. I call it as what here? Gross contribution. I'll tell you the reason for the name later. Now, D. There is other variable cost. Apart from, these are all production variable cost, no. Apart from manufacturing variable cost, there's going to be administration and selling variable cost, so no. Salesman commission is that variable cost or not? Yes. In that case, I also reduce variable what? Administration and selling. Should be what? Reduced. The capital E, I call it as what? Contribution. I call it as what? Contribution. This is item E. Respond yes or no? Now, next, F is, to this contribution, I reduce fixed cost. What fixed cost? Fixed manufacturing, administration, selling. I reduce it. What I get is called as what? Capital G, profit. What I get is called as profit. That's a marginal costing income statement. I'll explain further. Everybody following or not? Now, tell me sales minus variable cost of goods sold gives you gross contribution, minus variable selling and administration gives you what? Contribution, minus fixed cost gives you the profit. Now, listen here. Sales minus cost of goods sold is called as gross profit. Is called as what? Gross profit. I don't say sales minus cost of goods sold is profit. I call as what? Gross profit. Because the word gross indicates profit outside the factory. When it comes out of the factory, what profit you earn? That is the X factory profit. I call as what profit? Gross profit. Then all the expenses incurred in office and sales depot should be what? Further reduced to find out real profit or not. So whenever the word gross is used, it means the profit is earned outside what? Factory. I call as a gross profit. Yes or no? Hence I call this not profit but as what? A gross profit. From the gross, we reduce what? Non-manufacturing. I'll be getting the net profit. Ennappa, right or not? In the issue, now same way, from the sales, all these costs are non-manufacturing, manufacturing. From the sales, if we reduce only manufacturing costs, what I get is what? Gross. I can call it what? Gross. Since I use the word gross here, yes or no? But to call something as profit, I should have reduced variable and fixed costs. IPCC marginal costing, sales minus variable cost, contribution. When fixed cost you want? Profit. So sales minus cost only gives you profit. Sales minus variable cost gives you what? Only contribution. Yes or no? Now tell me, in this cost of goods sold, I call it variable cost of goods sold, is fixed manufacturing cost there or not there or not there? Since there is no fixed cost inside there, I cannot call this number as profit and call it as what? Contribution. Okay. I don't call it as contribution, I call it as what contribution? Gross contribution. Why gross contribution? Still, non-manufacturing variable cost has not been reduced. Yes or no? The word gross is used because only manufacturing variable costs are reduced. The word contribution is used because manufacturing fixed cost is not reduced. It is called as what? Gross contribution. Everybody following not? Now, from the gross contribution, what is the other variable cost here? Selling and expense. From the gross, if I reduce what? Selling and variable expenses, I get what? Contribution. Yes or no? So, this number is sales minus variable cost. The variable cost includes variable manufacturing cost and variable selling and administration cost. From contribution, what I should reduce? Fixed cost. What are the three fixed costs here? Fixed manufacturing cost, fixed administration cost, fixed selling cost. When I knock it out, I will be getting the profit of the company. Right or not? So now tell me, why I call this as gross contribution? Why the word gross is used? Because non-manufacturing costs are not yet reduced. Why the word contribution used, not profit? Because the fixed cost is not reduced. So this number doesn't consist of what? Fixed cost. Doesn't consist of what? Non-manufacturing cost. Since it does not consist of non-manufacturing, I give the name what? Gross. Does not consist of what? Fixed cost. I call as what? Contribution. The name is gross contribution. Yes or no? From the gross contribution, if I reduce what? Other variable costs, I mean administration and what? Selling, all variable costs are reduced or not. Now we can boldly call as what? Contribution. From that contribution, what is balance to be reduced? All the fixed costs. I get what? Profit of the company is a marginal costing income statement. Respond yes or no? In this under absorption, over absorption will take place or will not take place or will not, because the fixed manufacturing cost written here is what? Actual. I don't have the headache of unitizing it at what rate? Standard rate absorbing, because I have to be the actual, how it will be the office salary and selling expenses. Everybody following on this absorption costing and marginal costing income statements. Now, please tell me first. Marginal costing income statement. A is what? Sale. Minus variable cost of goods sold. What variable cost of goods sold? Opening stock of finished goods and variable cost of production minus closing stock of finished goods. So the sales minus variable cost of goods sold gives you what? minus what? Variable administration and selling gives you minus fixed manufacturing, administration and selling gives you the profit of the company. When I value stock, I value my opening and closing stock at what cost? Variable manufacturing cost. Should be understood. Yes or no? With this, we have completed a very, very lengthy discussion about the marginal costing versus absorption costing. Are you comfortable or not? Let's have notes in this regard before you go for the problems. I'll just give you 10 points as a notes. Then we can proceed. Okay, now, write down. Okay, proceed further. Marginal costing versus absorption costing, please. Marginal costing versus absorption costing. Point number 1. Please write quickly. Point number 1. Profit is equal to fill up the blanks. Sales minus expired cost. Profit is equal to sales minus expired cost. Point number 2. Cost can be classified into 2 types. Point number 2. Cost can be classified into 2 types. Branch it into 2. Product cost, period cost. Cost can be classified into 2 types. Branch it into 2. Product cost, period cost. Please. Product cost, put the down amount and write. Or those costs considered for. Product cost, put the down amount and write. Are those costs considered for what? Stock valuation. Are those costs considered for stock valuation. Period cost, put the down your remark and write. Are those costs not considered for stock valuation. Are those costs not considered for stock valuation. Product cost, branch it into 2. Product cost, branch it into 2. First branch, cost of goods sold. Any product may be sold, may not be sold. So what is attributable to sold units is called as what? Cost of goods sold. Second branch is stock. First branch is cost of goods sold. Second branch is stock. Cost of goods sold, put a down and write, expires. The product cost expires to the extent of what? Cost of goods sold. Stock is what? Unexpired. Why unexpired? The cost goes to the next year, leaves only one more year. Yes or no? It's called as what? Unexpired. Go to period cost. Down your mark. Expires fully. Period cost expires fully. Put the down your mark and write expires fully. Can I proceed on? Now. Point number 2 or 3? 3. In center right, cost. In the center right, cost. Branch it into 2. Manufacturing, non-manufacturing. The center right cost, branch it into 2. Manufacturing, non-manufacturing. Manufacturing, non-manufacturing. Non-manufacturing, if you want in bracket right, administration and selling. Non-manufacturing costs are administration and selling. Manufacturing further classified into 3. Material, labor, overheads. Manufacturing further branched into 3. Material, labor, overheads. Overheads further branched as variable, fixed. Overheads further branched into 2. Variable, fixed. Okay. Non-manufacturing, put a down a mark and write. It is always what? Period cost. Right? Always period cost. Non-manufacturing, put that down here and write, always period cost. Manufacturing, just club material, labor, variable overheads. Just club these 3, material, labor, variable overheads. Block it and write, always, what cost? Product cost. Material, labor, variable overheads, always product cost. Always product cost. Fixed overheads, branch it into 2. Fixed overheads, branch it into 2. Product cost under what system? Absorption costing system. Product cost under absorption costing system. Don't read as under absorption costing system. Product cost under a pause and then what? Absorption costing system. Product cost under absorption costing system. Second branch, period cost under what system? Marginal costing system. Period cost under marginal costing system. This point, having the clarity here, point number 3 or 4? Point number 4. Period cost under marginal costing system. Written or not? Next. Point number 4. Thus, marginal costing system values. Thus, marginal costing system values stock at what cost? Variable manufacturing cost. Marginal costing system values stock at variable manufacturing cost. Bracket right? VMC. We use it for convenience in the class. Okay, bracket right? VMC. Bracket close. And absorption costing values. And absorption costing system values stock at what cost? Full manufacturing cost. Absorption costing system values stock at full manufacturing cost. Bracket right? FMC. In bracket right? FMC. Full manufacturing cost. Bracket close. Point number 3 or 4? 5. Point number 5. Hence, in absorption costing, we should unitize. The word unitize is a verb. Okay, unitize means what? Calculating per unit. That's what I call as what? Unitize. Hence, in absorption costing, we should unitize. Unitize what? Fixed manufacturing overheads. Hence, in absorption costing, we should unitize fixed manufacturing overheads, which is done at what rate? Standard rate. Which is done at standard rate. Bracket la also called, which is done at standard rate. In bracket right, also called what? Predetermined rate or budgeted rate. Which is done at standard rate. Bracket la also called predetermined rate or budgeted rate. Also called predetermined rate or budgeted rate. Bracket close. Point number 5 or 6? 6. Standard rate is equal to what by what? BFO divided by BO. BFO divided by BO. When I use the word fixed overheads, I mean only manufacturing. Don't think all overheads. Here the fixed overhead means what? Contextually understand it. Okay. BFO divided by BO. Where the budgeted output is what capacity? Normal capacity. Where the budgeted output is normal capacity. And in the absence of information, 100% capacity can be considered normal. And in the absence of information, 100% capacity can be considered as normal. In the absence of information, 100% capacity can be considered as normal. Response yes or no? Point number 5 or 6? Okay, point number 7. Fixed manufacturing overheads, right? FMOH. Okay, fixed manufacturing overheads are charged to the cost of production. Fixed manufacturing overheads are charged to the cost of production at standard rate. Are charged to the cost of production at standard rate for what output? Actual output produced. fixed manufacturing overheads are charged to cost of production at standard rate for actual output produced. If you produce 1000 units, 1000 units standard will be what? Charged and so on for actual output produced. This is called what? Absorbed overheads. This is called absorbed overheads. This is called absorbed overheads. Point 8. At the end of the year, what is actually spent? At the end of the year, what is actually spent and what is absorbed may be different. At the end of the year, what is actually spent and what is absorbed may be different. Full stop. This difference is called what? Under or over absorption. This difference is called under or over absorption. This difference is called under or over absorption. I hope you are able to follow or not. This difference is called under or over absorption, which needs to be adjusted. While calculating. Absorption costing profit. Which needs to be adjusted while calculating absorption costing profit. We do plus or minus under or over absorption in the statement. It needs to be adjusted while calculating absorption costing profit. Next, point number 8 or 9? Point number 9. If the question is silent regarding, where should I dictate? Which needs to be adjusted while calculating absorption costing profit. It needs to be adjusted while calculating absorption costing profit. But repeat any point, have you written or not? Yeah, written or not? Now, last 2 points, then matter over. Can you see? Next, point 8 or 9? 9. Point number 9, please. If actual fixed cost is not given, number? Okay, that is okay. If the question is silent, regarding actual fixed cost, see, I am not making a written speech here, correct? Anyway, we can say, okay. So, if the question is silent regarding actual fixed cost, assume it to be same as budgeted. Assume it to be same as budgeted fixed cost. Assume it to be same as budgeted fixed cost. Assume it to be same as budgeted fixed cost. Okay. So 9 points over. Right or not? 10th and 11th point are format of income statement under marginal costing and then what? Absorption. We need not write the format because we will be doing a problem there. In the problem format can be written. Can you start with the problem or not? No. What happened here? Why are you shouting? Break land, never. Okay, see. The word I don't like in English is what? Break. Now, class slowly gaining momentum, I think. Learning how you sat here. Sit like that till the last class. Can I say? Now. All indiscipline comes due to Soumya answer. Okay. Can I proceed? Now. One thing, see, just a minute. Don't believe what he says, okay? Maximum real only. Never in the dream I will do maximization and minimization. Okay. Shall I proceed? So he is playing to gallery. Can I proceed? Now. Now, please stay. Take, please. Page number 211. Take page 211. Stop that, please. Take page 211. Question number 30. I will do that. I've been paid to do it. Can I ever say it? Now. Gavaniya. Question number 13. The chapter is Strategic Cost Management chapter. In which one of the issues discussed is absorption costing versus marginal costing versus throughput costing. Okay. About throughput costing, we'll discuss at that time. We are discussing now absorption costing versus marginal costing or not. Now, question number 13 deals with absorption costing versus marginal costing. Let's take that particular sum. Take question number 13 in that chapter. Please. Shh. From the following data. Okay. From the following data, don't talk, please. Calculate profit under marginal costing and B, absorption costing, and reconcile the difference in profit. Selling price 8 per unit, variable cost 4 per unit, fixed cost 2 per unit. Normal volume of production is 26,000 units per quarter. Tell me, what is this 26,000 units? Normal capacity. This would have been used to unitize the 2 rupees fixed cost. Respond, yes or no? No. The opening and closing stock consisting of both finished and equivalent units of WIP are as follows. Quarter 1, no opening stock, produced 26,000, sold 26,000, no closing stock. Quarter 2, no opening stock. Why? No closing stock in quarter 1. Are you awake or not? Now, produce that. Can I proceed? Now, produce 30,000, sold 24,000, closing stock is 6,000. Quarter 3, opening 6,000, produced 24, available to sell 30,000, sold 28,000, closing stock 2,000. Last quarter, opening stock 2,000, produced 30, available to sell 32,000, sold 32,000, and no closing stock. These are all the details given. Why this sum we are doing is, it covers all the eventualities regarding stock. First quarter, no opening, no closing. Second quarter, no opening, only closing. Third quarter, what? Opening and closing. Fourth quarter, only opening, no closing. In all the 4 quarters, how the profit behaves under marginal and absorption, we'll be seeing through this particular sum. Everybody following or not? No. Let's start with that discussion of the solution to this problem. Okay. First of all, before I start with the solution, let us make some observations so that clarity will be there when you prepare the income statement. Okay, see. Number 1. There is no administration and selling expenses given in this sum. There is no administration and selling expense. We can assume it to be 0. Due to that, profit will not change. Marginal costing and absorption costing profit will not differ due to what? Administration and selling. That is not an issue at all for discussion. Are you following what I am saying? Hence the problem does not focus on administration and selling expense. The treatment is same under both the systems. Are you following not? Hence it is not given. Are you following not? Now, all the costs given, variable and fixed cost, are all what cost? Manufacturing cost. Or what cost here? Manufacturing cost. Variable manufacturing costs are 4 consist of material, labor, variable overheads, and fixed cost consists of fixed manufacturing overheads. Understand that the cost given in the sum is what cost? Manufacturing cost. It is silent about administration and selling. You are assuming to be 0 for doing this sum. Point number 1. Are you following? Yes, point number 2. Fixed cost is 2 per unit. This is actual fixed cost per unit or standard rate. I always start using what rate here? Standard rate. This 2 would have been calculated using the formula BFO by BO. 2 rupees per unit is equal to what? BFO by BO. The budgeted output is maximum capacity, normal capacity, normal. For normal capacity, 26,000. BFO divided by 26,000 units gives you what? 2 rupees. Now, what the budget fixed overheads? Yeah, 52,000. My BFO is 52,000. It's not no. My budgeted fixed manufacturing cost for this place, how much is here? 52,000. Hence, I divided by what? Normal capacity of 26,000 units. And I'm charging 2 per unit for what? Every unit produced as a predetermined rate. Respond, yes or no? So the budgeted fixed cost is how much rupees here? 52,000. What the actual fixed cost? Given or not given? Actual fixed cost given or not given? Not given. I assume to be same as what? Budgeted. Same 52,000. Respond, yes or no? That means there's no expenditure variance in standard costing. BFO is equal to what? AF. But can the absorb be same? No. Absorption not only depends on numerator expenditure, all depends on what? Volume produced. Yes or no? So I don't say absorbed and actual are same. I only say what? Budgeted and actual are same in this particular case. Everybody following or not? This observation I make before I start the problem. Now tell me, number 1, 4 and 2 are manufacturing or non-manufacturing? The problem speaks only about the manufacturing cost. The 4 is what manufacturing? Variable manufacturing cost. The 2 is what? Fixed manufacturing overheads per unit. This is budgeted or actual? Budgeted. It is predetermined rate. How it is calculated? BFO by BO. Where the word BO is what? Normal capacity. 26,000 units normal capacity. The standard is what? 2 rupees. So what should be BFO? 52,000 rupees. BFO is BO into SR. BO is what? 26,000. SR is what? 2. That gives the budget fixed overheads. Respond is or no? And actual not given, I assume the budget to be same as what? Actual, or all the details given. Can we start doing the problem or not? No. Let's start with the calculation. Before that, if you do absorption costing, I value my stock at 8 rupees. I don't value my stock at selling price. At what price value my stock? 6 rupees. I value my stock at what cost? Full manufacturing cost per unit. It includes unitized fixed cost as standard rate. Yes or no? When I go for marginal costing, I value my stock how much rupees? 4 rupees. Variable manufacturing cost. Also should be remembered while doing the calculations. Can I proceed? Now, let me just start doing the problem. Can we do it together or not? No. Okay, please. Yes, on, off. Yes, yes. Yes. On manapa. Off the AC. Yeah. Confused manadi. Okay, no. Stop talking. Those who want to switch on the AC, raise your hand. Okay. For 10 minutes, after 10 minutes. Okay, now. This consensus. Like Arvind Kejriwal, whether to form government or not, I have to take voting. Please. Do you want to get portion completed? Then participate. Let us start with the calculation. Calculation of profit under what system? Marginal costing system. Please. Okay. Write down. Part 1. Calculation of profit under marginal costing system. Calculation of profit under marginal costing system. Okay. We can prepare the income statement in one single table for all the 4 quarters. Okay. No need to write again the items. Okay. Particulars, quarter 1, 2, 3 and then 4. Particulars, first quarter, second, third and then fourth. Please. Okay, let's write the format first. Capital A is what? Sales. Capital B, variable cost of goods sold. Underline that. Capital B, variable cost of goods sold, underline that. In that write opening stock, add what? Variable cost of production, opening stock, add variable cost of production, minus what? Closing stock, minus closing stock. The total is VCGS. VCGS means what? Variable cost of goods sold. The total is variable cost of goods sold. Opening plus VCOP minus closing. Next, from the variable cost of goods sold, what should I reduce here? Minus, we get what? Gross contribution. Sales minus variable cost of goods sold gives you gross contribution. Capital C is gross contribution, which is A minus B. A minus B. Next, variable selling and administration. Capital D is variable selling and administration. Variable selling and administration. The resulting number, what I get is what? Contribution. What I get is contribution. A is sales, B is what? Variable cost of goods sold, C is what? Gross contribution. In bracket write A minus B, and D is what? Variable selling and administration. E is what? Contribution. What is E contribution? C minus D. E contribution is C minus D. Tell me, what is F? Item F is what? Fixed manufacturing, selling and administration. F is fixed manufacturing, selling and administration. Fixed manufacturing, selling and administration. G. What is point G? Profit. What is profit? Contribution minus fixed cost. It is what? E minus F. Profit is E minus F. Contribution minus fixed cost. E minus F. Okay. Can we start doing the solution together? Now, you have to tell the calculation. I'll put in the slide. Okay, first. Quarter 1, how many units I am selling? Please look at the workbook. All of you, all numbers are in the workbook. How many units I am selling? 26,000 units. At what price? 8 rupees. Multiply and tell me what are the sales? 2,08,000. We'll now fill column by column. First quarter 1, 2,08,000. Please. Quarter 1 having any opening stock or no opening stock? No. Put nil or put dash. How many units I am producing in quarter 1? 26,000. What is the variable cost of producing every unit? 4 rupees. What is the variable cost of production? 26,000 into 4. I want a number. What is the number? 1,04,000. Variable cost of production is 1,04,000. Now, is there any closing stock in quarter 1? No. Put a dash. Okay. Tell me, opening stock plus VCOP minus closing stock 0 plus 1,04,000 minus 0. What variable cost of goods sold? 1,04,000. The variable cost of goods sold is 1,04,000. What is gross contribution? Sales minus variable cost of goods sold. 2,08,000 minus what? 1,04,000. Answer me, what's the number? 1,04,000. 1,04,000. Does the problem have any variable expenses? No. The administration selling expenses? No. Since it have not given any administration selling expense, assume to be what? Nil. You assume to be nil. What is then contribution here? 1,04,000 minus 0 gives you 1,04,000. Fixed cost is how much rupees? 52,000 rupees per quarter. 26,000 into 2. Yes, what fixed cost here? 52,000. My question is, what I write here 52,000 is budgeted actual. What I write here is what? Actual. In P&L, you don't debit budgeted cost here, correct? Debit only what cost here? Actual cost. But in this problem, the budget is same as what? Actual assumption. So it seems to be budgeted. But what I write is what? Actual here. Suppose the question says the company has spent actually 58,000 rupees as what? Fixed cost. Now, I'll write budgeted 52. Actual 58. Actual 58. That's a 6,000 rupees adverse expenditure variance. Are you following or not? So the word fixed cost here means what? Actuals. Ennappa right? Now, tell me what is the profit of the company? 1,04,000 minus 52,000 gives how much rupees? 52,000 is the first quarter profit of this company. Right or not? Yes, are you doing along with me? Now tell me second quarter. How many units I am selling? I want chorus and how many units I am selling? 24,000 into how much rupees? 8. What are the sales? 1,92,000. 24 into 8 gives you 1,92,000. Any opening stock? Nil. How many units I produce? 30,000. To produce every unit, what is the cost of production? 4. What is the variable cost of production? 4. To produce 30,000 units, what is the variable cost of production? 1,20,000. Now, listen here. Stop writing. Quarter 2 is having a closing stock or not? Remember, respond yes or no. How many units closing stock? The stock should be valued. Na? Stock should be valued at selling price, cost price. Should be valued at total cost, manufacturing cost. Full manufacturing cost, variable manufacturing cost. I should value my stock at how much rupees? Yeah, 4 rupees. How many units? 6,000. At how much rupees? 4 rupees. The stock value is 24. Respond yes or no. 24,000 rupees is the closing stock value. 0 plus 1,20,000 minus 24 gives you what is the variable cost of goods sold? 96,000. Sales minus variable cost of goods sold, 1,92,000 minus 96,000 gives you a gross contribution of 96,000. Gross contribution of 96. Any variable selling administration? No. The contribution is 96,000. Fixed cost continues to be same 52 because volume changes, fixed cost will not change. Remains what? Same 52,000. The profit of that quarter is 44,000. Quarter 2 profit 44,000 under marginal costing system. Right or not? Now, come to quarter 3. How many units I am selling in quarter 3? 28,000. At what rupees selling price? 8 rupees. Calculated 28,000 into 8. What are the sales? 2,24,000. 2,24,000. What is opening stock? 24,000. Closing stock of quarter 2 becomes what? Opening stock of quarter 3, 24,000. Now, what is the number of what are the number of units produced? 24,000. What is variable cost of production? 24 into 4 gives you 96,000. The variable cost of production is 96,000. Is there a closing stock? Yes. How many units? 2,000. Valued how much rupees? 4 rupees. The closing stock value is 8,000. 24 plus 96 minus 8 gives you variable cost of goods sold of 1,12,000. Variable cost of goods sold is 1,12,000. The gross contribution is sales minus VCGS gives you how much rupees? 1,12,000. Gross contribution 1,12,000. Is there any variable administration expenses? Nil. It's going to be nil. What is contribution amount? 1,12,000. Will the fixed cost change or will not change? Will not change. Remains what? Same 52,000. Fixed cost is 52,000. What is the profit? 60,000. Quarter 3 profit under marginal costing system is 60,000. Respond yes or no. Last quarter. How many units I am selling in quarter 4? Tell me 32,000 units. At how much rupees? 8 rupees. Tell me the amount here. 2,56,000. 2,56,000. What is the opening stock? 8,000. Closing stock becomes the opening stock. Opening stock 8,000. How many units I am producing? 30,000. What the cost of producing every unit? 4 rupees. What variable cost of production? 1,20,000. Variable cost of production is 1,20,000. Tell me how many units are there in closing stock? 0. The variable cost of goods sold is 1,28,000. Gross contribution is 256 minus 128 gives you 1,28,000. Gross contribution is 1,28,000. What is variable administration selling expenses? Nil. What is contribution? 1,28,000. Contribution 1,28,000. What is fixed manufacturing administration selling expenses? 52,000. The profit is going to be 76,000. Profit is 76,000. With this we have completed what system? Marginal costing system. 4 P&Ls are prepared for quarter 1, 2, 3 and 4. 4 periods profit has been computed. Right or not? Same process we have to undergo for what system? Absorption costing system. Can I proceed or not? No. Let's give the heading. Part 2. Profit calculation. Calculation of profit under absorption costing system. Calculation of profit under absorption costing system. Can I start or not? No. Have the following columns same. Particulars quarter 1, 2, 3 and then 4. Okay. Now, capital A is what? Sales. Capital A, sales. Capital B is what? Cost of goods sold. Underline that. Capital B, cost of goods sold. Underline that. Within the right what? Opening stock. Opening stock. Add what? Cost of production. Opening stock. Add cost of production minus closing stock. Opening stock. Add cost of production minus closing stock. The total number we call as what? Cost of goods sold. I call it as cost of goods sold. So capital E is sales, capital B is what? Cost of goods sold. What is capital C? Gross profit. Capital C is gross profit. A minus B. Sales minus cost of goods sold gives you gross profit. Okay, just a minute. Do we have in this some administration selling expenses? No. I need not unnecessarily write and put dash. Can I ignore that number or not? Yeah. I wrote for the marginal costing for you to get an understanding, that's all. Since administration selling is what? Nil. Can I omit from this statement or not? Yes. So gross profit. Then no administration, no selling. Next is what? Plus or minus under or over absorption. Gross profit. Now D is plus or minus under or over absorption. D is plus or minus under or over absorption. Normally, before this number, there will be another number called as what? Administration and selling expenses. Since we don't have this in this sum, I ignore that particular data. Can I ever say plus or minus under or over absorption? That gives you what? Profit. That is going to give me profit. Okay. Shall I proceed? Now, we can fill up the statement later. Let's have a working note called as under or over absorption calculation. Right? Working note number 1. Working note number 1. Calculation of under or over absorption. Working note number 1. Calculation of under or over absorption. Okay, can you start or not? No. Have the 4 columns, particulars, quarter 1, quarter 2, quarter 3 and quarter 4. Have the 4 columns, particulars, Q1, Q2, Q3 and then Q4. Can you start or not? No. In that right? First. A. Actual overheads. Actual overheads. Actually, how much fixed overheads I am spending? That is budgeted or actual? Both are same in this sum. But here I use what? Actual for that. Under absorption or over absorption is column 1 minus 2. Yes or no? What is column 1? Absorb. What is column 2? Actual. Budget will not come for under or over absorption calculation. Right or not? Now, in the case, actual overheads, every quarter write the amount as 52,000. 52,000, 52,000, 52,000. The actual overheads is 52,000 for all the 4 quarters. Can I proceed? Now, capital B is what? Absorb overheads. Can you tell me what absorbed overheads? AO into SR. Right or not? Every unit I produce, I charge 2 rupees. Yes or no? So, how many units produce? So much I will absorb. It's going to be AO into SR. Please tell me for first quarter, look at the workbook and tell me how many units I am producing? 26,000 units. Every unit is charged with how much rupees here? 2 rupees. So the absorbed overhead is going to be how much rupees here? 52,000. 26,000 units into 2 rupees. Absorbed overhead is going to be 52,000. Respond. Have the clarity here? Now. Second quarter, I am producing how many units? 30,000. Each unit takes into it how much fixed cost? 2 rupees. So to the cost of production, how much is absorbed here? 60,000. The absorbed is 60,000. Quarter 3, how many units I am producing? 24,000. Each unit takes how much rupees here? 2 rupees. So what is absorbed overhead? 48,000. Quarter 4, I am producing how many units? 30,000. Each unit absorbed how much rupees here? 2 rupees. So the absorbed overhead is going to be how much rupees here? 60,000. This is the amount that are included in the cost of production. Everybody following or not? Now, tell me the difference. I'll be calling it as what? Under or over absorption. I call as under or over absorption. Quarter 1, I spend 52. I also charge how much? 52. Under absorption or over absorption? No. It is what? Nil. Quarter 2, I spend 52, but I absorb how much? 60. Under or over? How much is here? 8,000 rupees. I just put it down again, right? What absorption? Over absorption. 8,000 rupees over absorption. Now, quarter 3 spent 52, absorbed only what? 48. How much is here? 4,000. Under or over absorption? It is under absorption. 4,000 under absorption. Quarter 4, I spent 52. I absorbed how much? 60. What's the amount here? 8,000. Under or over absorption, it is over absorption. Right. Over absorption means cost is over debited. Cost is what? Over debited. Instead of debiting 52, in my profit, I debit how much is 60. When I over debit a number, what I should do? Credit it back. Crediting means what? Add to the profit. Under absorption means what? I spent 52, I debited only what? 48. Then 4,000 is what? Under debited. What I should do? Debit. I should add or subtract from the profit. That you have the clarity or not. So over absorption should be added to the profit. Under should be what? Subtracted. That is overcharge. So reverse the charge. This is what? Undercharge. Charge more cost. Everybody, are you following or not? This is regarding under or over absorption calculation. Can I move to the next stage or not? Now, please come back to our original slide. Let's start doing the first part. Okay. You should tell me the numbers. First quarter, how many units I am selling? How many I am selling? 26,000. In how much rupees selling price? 8 rupees. The sales is 2,08,000. 26,000 into 8 rupees. The sales is 2,08,000. Any opening stock? No. To produce every unit, the manufacturing cost is, how much rupees here? 6 rupees. How many units I am producing? 26,000 units. So multiply and tell me 26,000 into 6 is what the cost of production? 1,56,000. Respond yes or no? Now, any closing stock is there or not? No. That means the cost of goods sold is opening stock plus cost of production minus closing stock gives you 1,56,000. The cost of goods sold is 1,56,000. Sales minus cost of goods sold, 2,08,000 minus 1,56,000 gives you a gross profit of 52,000. Gives a gross profit of 52,000. Any administration selling expenses? No, leave it. Any under or over absorption? No, nil in quarter 1. So the profit is also how much base? 52,000. Profit is 52,000. Please tell me yes or no. Okay. Quarter 2. Participate. How many units I am selling in quarter 2? How many units here? 30. 30? How many units I am selling? 20. I am selling how many units here? 24,000 units. Yes or no? I am selling how many units? 24,000 units. Every how much rupees? 8 rupees. The sales is 1,92,000. Sales is 1,92,000. Any opening stock? No. I have produced how many units? 30,000. To produce every unit, what the cost spent? 6 rupees. To produce 30,000, what the cost spent? 1,80,000. The cost of production is 1,80,000. Is there any stock or not? Yes. How many is in stock? 6,000. Stop writing and tell me. 6,000 unit stock should be valued at 8 rupees selling price. Should I value at total cost? No. I value at what? Full manufacturing cost. Yes or no? What full manufacturing cost? 4 rupees variable, 2 rupees unitized fixed cost. I value my stock at how much rupees? 6 rupees. So 6,000 unit stock should be valued at how much rupees? 36,000. 6,000 unit stock is valued at 36,000. Respond yes or no? No. Opening stock plus cost of production minus closing stock. 0 plus 1,80,000 minus 36,000. Tell me what is the cost of goods sold? 1,44,000. Cost of goods sold is 1,44,000. And any administration expenses? No. And we are going to have a before that gross profit. What is the gross profit? 48,000. No administration and selling expenses. Is there under or over absorption? Yes. Under absorption, over absorption, over absorption. Look at the first working note here. How much the base? 8,000. Subtract, add 8,000. Over absorption, add 8,000. The profit is 56,000. The profit is 56,000. Respond, yes or no? Next, come to quarter 3. How many units I am selling in quarter 3? Everybody, how many units I am selling? 28,000. And how much the base? 8 rupees. 28 into 8 gives how much sales? 2,24,000. Gives you 2,24,000. What the opening stock? 36,000. Closing becomes opening 36,000. How many units I am producing? Tell me. How many units here? 24,000. To produce every unit, what is the manufacturing cost? 6 rupees. 24,000 into 6, what is the manufacturing cost of production? 1,44,000. The cost of production is 1,44,000. Is there any closing stock? Yes. How many units? 2,000 units. Should be valued how much rupees here? 6 rupees. The stock value is 12,000. The stock value is 12,000. 36 plus 1,44,000 minus 12,000. What is the cost of goods sold? 1,68,000. And the gross profit is sales minus cost of goods sold. What is the gross profit? 56,000. Any administration selling expenses? No, ignore it. Is there under or over absorption? Yes. Under absorption, how much base here? 4,000. Add or subtract? Subtract 4,000 under absorption. I get a profit of 52,000. Quarter 3 profit is 52,000. Respond yes or no. Next. Quarter 4. Okay. How many units I am selling in quarter 4? 32,000 units. At how much price? 8 rupees. Everybody understanding and writing or not? So 32,000 into 8. What is the sales here? 2,56,000. Okay. Opening stock how much? 12,000. Last quarter closing stock become this quarter's opening stock. How many units produced? 30,000. And how much cost of production? 6 rupees. 1,80,000 is cost of production. No closing stock. Nil. What is the cost of goods sold here? 1,92,000. Cost of goods sold is 1,92,000. Sales minus CGS. Gross profit is 64,000. Gross profit is 64,000. Any under absorption, over absorption? Yes. What over absorption? 8,000. What the profit? 72,000. The profit is 72,000. We have prepared income statement under marginal and then what? Absorption costing system. Up to this calculation, everybody following or not? Okay. Now, the last stage of discussion we'll make, then we can revert back to the standard costing chapter. Okay, please. Shh. Okay. Both the systems report same profit, different profit. The profits are what? Different. Quarter 1 may be same. All the remaining quarters are what? Different. So the profit is different under both the systems. It's or no? For the same company, can there be two profits? Who said no here? There can be so many profits for a company. I'm not saying black. I'm saying what? White only. Can be what? Because it all depends on your accounting policies and assumptions. Yes or no? You follow SLM. I follow what? WDV. Profit may change. You follow LIFO for stock. I follow what? FIFO. The profit may what? Change and so on. Profit can be different based on how you calculate it. Yes or no? That is why. How we calculate absorption costing, how we calculate marginal costing, the method is different. The profit also is what? Different. The question is why the profit is different is going to be analyzed now. Are you following? That is the key observation I have to have for doing reconciliation under marginal and absorption costing. I mean standard costing later. Ennappa, right? Now, please follow here, please. Now, marginal costing, absorption costing. Why the profit is different? I'll tell the reason. You tell me that it is true or false. Okay. See, in marginal costing system, fixed manufacturing overheads debited is actual absorbed. Simply, marginal costing system, the FM watch 52,000 here no, it is actual absorbed, actual. I don't have the process of absorbing whatever I spend. I debit actual fixed manufacturing overhead in marginal costing system. Yes or no? No. In absorption costing system, is the income statement or not? In that, where is the fixed manufacturing overheads? Yeah. Inside this cost of production. Inside this what? Cost of production. For example, 1,80,000 rupees is cost of production for quarter 2. Right? Tell me how I got it. I produce how many units? 30,000 units. How many units I produce here? 30,000. To produce 30,000 units, the variable cost how much rupees is 4 rupees. In that 1,80,000, 1,20,000 is variable cost of production, and the balance 60 is what? Fixed cost of production. That 60,000 is actually absorbed. I actually spent only 52. Yeah, absorbed only how much? 60,000. So in that case, I have debited fixed cost in absorption costing also, but the fixed cost inside the cost of production is not actual. It is what? Absorbed. Ennappa, right? Tell me yes or no. In marginal costing, I debit the actual fixed overhead. In absorption costing, I debit what? Absorbed fixed overheads. So because of this difference only, the profit is different. True or false? Question now, please listen here. First settle down. Now, again I repeat. Listen. You are making me teach three times every time. Yeah, okay, so fees only once you paid, and they also paid me fees only. To understand that, yeah, I am teaching you IPCC, I am teaching you final, sometimes CPT also, difference analysis run. Okay, now, but happily teaching, nothing there, but cooperating. Can I say it? Okay, now, shall I proceed? Now, listen here, please. In absorption costing, inside cost of production, fixed cost is that, yes or no? Yes, sir. I have debited cost of production against sales or not? When I debited cost of production, did I debit the actual cost of production, absorbed cost of production? You know, what I debit is not 52, what I debit is what? 60 in quarter 2, example, yes or no? In quarter 3, what I debit is not 52, is only what? 48. So, the fixed overheads accounted for in absorption costing is absorbed, in marginal costing is what? Actual. Due to this difference, under absorption, over absorption only, the profit differs. True or false? Because it has been adjusted. Ultimately, in absorption costing also, I might have debited how much rupees here? 60,000. I credited back what? 8,000. The real debit is only 52. In absorption costing also, ultimately, what they account for is only what? Actuals. Correct? Absorption costing also debits 52. For example, quarter 3, in this 1,44,000 rupees cost of production, what fixed cost of production? 40. Correct? But I also adjusted for what? Another 4,000 under absorption. I accounted 52. Am I right or not? Now tell me, in marginal costing and absorption costing, sales same. Yes, sir. The cost debited also same. Yes, sir. Why cost debited same? Ultimately, I debit the actual fixed cost only in absorption also. Credit side sales also same. Debit side what? Cost also same. The profit should be same. Yeah, correct. Question the sales also same, the cost also same, debit same, credit same. Why the profit is different? Because of stock valuation. Because of what? Stock valuation. The only reason for difference between absorption and marginal costing profit is what? The stock valuation. Absorption values the stock at 6 rupees and marginal how much rupees? 4 rupees. The 2 rupees per unit inside stock only is going to cause a reason for the profit difference. Yes or no? That means in marginal costing, entire fixed cost dies in the same year. Absorption costing, when I have a build-up of stock, a part of the current year fixed cost, I can take it to the next year through the stock. Yes or no? That means absorption costing profit should be more by the fixed cost inside stock or less by the fixed cost inside stock. Or in what I am saying, let us see how the profit should be reconciled now, and then we can just consolidate this particular discussion. I will do it and then later I can copy. Can I reconcile two profits or not? Now, please tell me. Okay. Quarter 1, quarter 2, quarter 3 and quarter 4. Please. Okay. Opening stock. Tell me what is the opening stock and okay, closing stock. First quarter what? Nil. Second quarter what is the opening stock? Nil. Closing stock. Third quarter. And then 2,000. Fourth quarter. This is a stock question for each and every quarter. Am I right or not? No. I'll write net stock. Net stock is nil. Stock has increased or decreased or increased. I started the year without a stock. I ended with what? 6,000. So that's a net stock increase. How much here? 6,000. The beginning of the period I had 6,000. I had only what? 2,000. Stock increase or decrease or decrease? How much decrease here? The stock has been liquidated. Decreased by 4,000. It's going to be what? Increase, decrease or decrease by 2,000. Respond. Are you following or not? No. Next. Fixed cost in net stock. Fixed cost in what? Net stock. Every unit has got in it 2 rupees fixed cost. That means here how much going to be? 0. 6,000 rupees how much? I write plus 12,000 minus 8,000 minus 4,000. Okay, next. Marginal costing profit. You look at your notebook and tell me the profit under marginal costing. First quarter, what the profit under marginal costing? 52,000. Second quarter, 44,000. Third quarter, 60,000 above. Right? Okay. Fourth quarter, 76,000. Now, if I adjust, I'll be getting what? Absorption costing profit. Okay. Tell me, how much is here? 52,000. 44 plus 12, 56,000. 60 minus 8, 52,000. And next is how much here? 7,000. This is going to be the profit under what system? Absorption costing system. Respond. Are you following? Now, I'll tell you what is happening here. What is happening here? See. When stock increases, when stock what? Increases, absorption costing profit increases. Understand first. That is, if closing stock is more than what? Opening stock. Look at the conclusion. If closing stock is what? More than opening stock, which profit is more? Absorption costing. If closing stock is less than opening stock, the net stock is decreasing, which was more profit? Marginal costing. If the stocks are same or there is no stock, which is going to say more profit? Same profit under both systems. Point number 1. Are you following not? Yes, let's see the reason. Very simple here. Now, net closing stock means, look at the trading. Net closing na, net debit or net credit. Opening stock, you will debit or credit. In 11 side portion, opening stock debit or credit? Debit. Closing stock what? Credit. Simply, net closing stock. Closing stock net is what? Net credit. Is accepted? That is why credit na plus, right or not? So net closing stock means what? Net credit. Net opening stock means what? Net debit. Did you understand or not? Yes, in absorption costing, I debit or credit at 6 rupees. In marginal costing, I debit or credit with how much rupees? 4 rupees. So the difference is 2 rupees extra debit or extra credit. Yes, right or not? Now, in absorption costing, when the stock increases, I have a net credit of 2 rupees extra. When 2 rupees extra credit comes, profit goes up or comes down? Goes up. So, for 6,000 units, I am taking extra credit how much rupees here? 12,000. So, absorption costing is 12,000 rupees more than what? Marginal costing profit. Are you following or not? To more logically understand what happens is, in marginal costing, the entire 52,000 rupees fixed cost stops in this year. In absorption costing, out of the fixed cost, 2 rupees fixed cost inside what? 6,000 is escaping from this year and goes to what? Next year, thereby increasing the current year profit. When I postpone a cost, profit gets what? Inflated. So 6,000 units fixed cost goes to what? Next year, thereby the profit gets inflated by 12,000 rupees. Respond. Are you following? Vice versa. Net opening stock means net debit and net credit. Net debit. In absorption, I debited how much rupees? 6 rupees. Marginal how much rupees? 4 rupees. Absorption has an extra debit of 2 rupees per unit or not. That means the profit increases or decreases or decreases. The profit is less than what? Marginal costing profit. Are you following? Very simple. The fixed cost brought forward from last year is more than what is taken to next year. Opening stock brings in the previous year fixed cost to this year, and closing stock takes the current day fixed cost to what? Next year. When I have a net opening stock, what is brought in is more than what? What is taken out. The cost debit is more, the absorption costing profit is what? Less. Under the second situation, are you following? Yes, tell me, marginal costing, absorption costing, profit is different because of under absorption, over absorption. True or false? It has been what? Adjusted. It is different because of what? Stocks. When I have a net closing stock, when I have what? Net closing stock, which is having more profit? When I have a net closing stock, which is having more profit? Absorption. Net closing stock means what? Net credit. Always debit or credit, absorption more. Absorption, debit or credit at 6 rupees. Margin only how much rupees? 4 rupees. Always absorption will be having an over debit or over credit depends on stock portion. Now, net credit now, absorption having what? Over credit. The profit is what? More. Net debit means what? Absorption having what? Over debit. The profit is what? Less. So when I have more closing stock than opening stock, which will show more profit? I am asking that question third time. Which will show more profit here? Absorption costing. When the opening stock is more than closing stock, which shows more profit? Marginal costing. When the stocks are same or net stock is zero, which shows more profit? Same profit. That's why quarter one, the profit is what? Same under both system. Quarter two, absorption costing profit more because net opening stock. Quarter 3 and 4, marginal costing is what? More because of net opening stock. Is the reason for the difference in profit. Are you following or not? With this we complete this concept for the time being. Area called what? Absorption costing versus marginal costing. How it affect the management reporting, what is throughput costing, how to calculate break-even point. There are so many other issues in this area to be discussed. We'll discuss it at the appropriate time in different chapters. I want to discuss only this part is relevant to do the standard costing chapter. Right now, next. Reconciling. Lot of time is there. Reconciling marginal costing and absorption costing profit. Reconciling marginal costing and absorption costing profit. Reconciling marginal costing and absorption costing profit. Particulars Q1, Q2, Q3 and Q4. Particulars quarter 1, quarter 2, quarter 3 and quarter 4. Right, opening stock, closing stock. Opening stock, closing stock. Quarter 1 nil nil. Opening stock, closing stock. Quarter 1 nil nil. Quarter 2 opening stock nil, closing stock 6,000. Opening stock nil, closing stock 6,000. Quarter 3 opening 6,000, closing 2,000. Quarter 3 opening 6,000, closing 2,000. Quarter 4 opening 2,000, closing nil. Quarter 4 opening 2,000, closing nil. Net stock. Net stock. What is quarter 1 net stock? Nil. Quarter 2 stock increase or stock decrease? Stock increase. How much increase here? Plus 6,000. The plus 6,000 indicates net debit or net credit? Net credit. Quarter 3 it is minus 4,000. Why minus 4,000? Stock has decreased. Net credit or net debit? Net debit. Quarter 4 is minus 2,000. Quarter 4 is minus 2,000. Fixed cost in net stock. Fixed cost in net stock. Fixed cost in net stock. Quarter 1 nil. Inside every unit of stock, I have how much rupees fixed cost? 2 rupees. So quarter 2 it is 12,000. Quarter 1 nil. Quarter 2 12,000. Quarter 3 minus 8,000. Quarter 3 minus 8,000. Quarter 4 minus 4,000. Quarter 4 minus 4,000. Marginal costing profit. Marginal costing profit 52,000. Marginal costing profit 52,000, 44,000, 60,000, 76,000. 52,000, 44,000, 60,000 and then 76,000. Absorption costing profit. You adjust it now. Absorption costing profit. Marginal costing profit plus or minus fixed cost inside what? Net stock. 52,000 plus 0, 52,000. 44,000 plus 12,000, 56,000. 60 plus a minus 8,000, 52,000. 76 minus 4, 72,000. 76 minus 4, 72,000. This is the profit under absorption costing system. Write down notes. 2 points. I'll complete. Please write down notes. We cannot have this discussion next class. Yeah, write down notes. Point number 1. Is the difference between the profit under the two systems is the difference between the profit under the two systems is the difference between the profit under the two systems due to under or over absorption. Is the difference between the profit under two systems due to under or over absorption. Correct, yeah? Okay, due to under or over absorption. Due to under or over absorption. Question mark. So is that the answer? What is the answer here? No. Because it is already adjusted. No, because it is already adjusted while calculating. No, because it is already adjusted while calculating absorption costing profit. No, because it is already adjusted while calculating absorption costing profit. While calculating absorption costing profit. Point number 2. Then why the profit is different? Point number 2. Then why the profit is different? Question mark. It is due to the stock valuation. It is due to the stock valuation. It is due to the stock valuation. Marginal costing values stock at, it is due to stock valuation. Marginal costing values stock at, marginal costing values stock at what? VMC, variable manufacturing cost. Marginal costing value stock at variable manufacturing cost, and absorption costing at full manufacturing cost. And absorption costing at full manufacturing cost. The difference is fixed cost inside. The difference is the fixed cost inside. Fill in the blank. Fixed cost inside what? Net stock. Don't say inside stock. Inside opening stock as well as what? Closing stock. No. The difference is the fixed cost inside net stock. The difference is the fixed cost inside net stock. Branch it into 3. Last year, okay, branch it into 3. Branch it into 3. First branch. Net stock 0. First branch, net stock 0. Second branch, net closing stock. Second branch, net closing stock. Third branch is what? Net opening stock. Third branch is net opening stock. Go to first branch, put the domain and write. Net stock 0 means no change in stock position. Net stock 0 means no change in stock position. Net closing stock means what? Stock increases. Net closing stock means stock increases. Net opening stock means what? Stock decreases. Stock increases, stock decreases. Next, write down. Write down. First branch, right? Both system shows same profit. Both system shows same profit. Both system shows same profit. Second case, which shows more profit? Absorption shows more profit. Absorption shows more profit. Third case, marginal shows more profit. Marginal shows more profit. Okay. This is regarding the primary level discussion regarding the marginal costing versus absorption costing. Next class we will complete sales variance and start doing big reconciliation problems. Tomorrow you don't have AMA class. Next class is on Tuesday.